Okay, so hello, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes, thank you. So, in the previous session, we discussed about, or previous sessions, we discussed about the foreign exchange risk management. Now, this chapter is an extension of that. So, don't get relaxed that foreign exchange chapter is over. Uh, this chapter also could have been asked in the previous chapter, but somehow it has some more theory concepts and some more variety of problems which requires understanding of the foreign exchange risk management chapter. So what kind of questions you'll expect here? What type of problems you can expect in this area? Okay, you have to understand certain basic terminologies. I will not spend much time. I'll quickly run through it. Like we have FDI, FII, foreign direct institution, foreign institutional investors, or foreign direct investment, FDI, foreign direct investment, FII, foreign institutional investor, and now they're called as actually FPI, foreign portfolio investors. So basically, the difference is FDI people are long term people. They come to India, they start a company in India. Like Microsoft has a company in US, they start a subsidiary in India, they start a company in India with some percentage of ownership. Microsoft India, that is FDI. FII, FPI people, they keep buying the shares of Infosys share, TCS share, HDFC Bank shares, and they sell it also. That is, they, like you and me, buy in the secondary market, in the stock exchange mainly. They are called as foreign institutional investor or foreign portfolio investor, where their goal is not long term and their goal is short term, and they are not interested in day to day operations. Anyway, that is regarding FDI, FPI, that you don't worry much. Then you will have this one thing called as ADR or GDR. Even questions in the exam, they will ask you like this. Okay, so what type of questions you can ask? Just try to understand. So this chapter, International Financial Management. Here, basically, we talk about two types. Some companies coming into India and starting their business, or some companies going outside India and starting their business. Broadly, we'll have two types of problems. Or I'll say, overall, I have seen four types of problems in this chapter. Four types of problem, broadly. First type, a problem on ADR or GDR, to be specifically Global Depository Receipts, about pricing and cost of GDR, like cost of equity, cost of debt, cost of capital, cost of GDR. They will ask you a question on this. And the next variety is a foreign company coming into India. Foreign company coming into India. Broadly, here you will have one type of problem which are capital budgeting problems. We calculate in PV. The other is like a starting a subsidiary. That is, a company will be the holding company as well as they will be, uh, what do you say, a seller. They are the customer. So they are a holding company and they will be a customer. A problem like a transfer pricing problem. They start a unit in India, they produce the product, they only purchase and then they sell it. So question will be, should they sell it directly or should they come to India and take it, make the production and then go there and sell it to, in the US. That is what you'll have one time question I've seen. And then Indian company going outside India, Indian company going outside. Here, typically, we have two methods actually. We discussed little later. One is cash flow in foreign currency, and then you convert it to rupees, but the question can be in cash flow in rupees, or we express ultimately cash flow in INR terms, local currency. FC is foreign currency, cash flow local, LC local currency. Cash flow in foreign currency or cash flow in local currency. We have two methods, but only one problem. Ultimately, we are going to calculate NPV only. Ultimately, we are going to calculate NPV and we decide whether the project should be accepted or not. And one more area of questions what I've seen is surplus fund management problems. This will be like a company will have their head office in US, a surplus fund management or treasury management, you can say. Treasury management. So they'll have a surplus fund in, let's say they are having office in London, but they can invest the money in London only, they can invest the money in US, or they can invest the money in France for 3 months kind of thing. So where the investment is better, which investment gives the highest return? Surplus fund management, treasury management is one type of questions that I've observed. Okay, so let me talk about the each individual about at least 5 minutes each, then we'll go further. So first variety of small questions, what you will come across, questions only I'm focusing, that is on GDR or ADR. DR stands for depository receipts. How this works, quickly I will tell you. This is basically applicable for an Indian company in India, they want to raise money outside India, let's say from USA. So they want to raise money outside India. They want to raise the capital not from Indian investor but from foreign people. So what they do, the company in India, they will issue the company shares, or at least they will deposit shares. We call them as custodians with people, for example, SBI. We have more popular, Infosys shares gets listed in USA. HDFC Bank shares gets listed in USA. How can you call like that? That means their Indian shares are not listed. Their equivalent deposit receipts are listed. How it's going to happen? Quickly I'm telling you. So company in India give shares or issue shares to custodian. For example, SBI. And what they will give, they will issue. So these people give shares and these people issue DRs, depository receipts. For example, one deposit receipts equals to like 3 shares, something like that. Example, they will issue to a custodian in USA, or for example, let's say some foreign bank. They are custodian there, and they will issue the deposit receipts. They will issue the deposit receipts to the US investors or US citizens. So when you say that Infosys is listed in a New York Stock Exchange, Infosys shares are not listed. Infosys depository receipts are listed. And when you convert it to deposit receipts, they will convert from rupees into, let's say, dollars. So one deposit receipts are represented in dollar terms. So you will also have exchange rates. So whether they are eligible, they are not having shares. They are having deposit receipts. Now, do they have voting rights? All those things you learn in law. I don't want to confuse you further. This is the basic structure of deposit receipts. When an Indian company wants to issue the share to a US citizen, they take the route of depository receipts. So when a US investor purchase the deposit receipts of Infosys, let's say, they become the shareholders of Infosys. So if Infosys share price goes up, then we say that the deposit receipts also will go up. And dividend if company pays, they will also will get it. But only thing is, this will also be converted into exchange rates. So this deposit receipt rates is influence of two things. One is the number of shares you have and the conversion rates. For these two reasons, the DR will fluctuate in the US stock exchange. So this way, a US person can become investor of Indian companies. An Indian company, if having a good brand, good name, they can raise the money even from outside India. What is ADR? It's listed in American company, I mean non-American company listed in American company, Infosys in America. Non-American company coming into America, that's called as ADR. And if they go elsewhere, but expressed in dollar term only, that's called as GDR. So both are very similar. Don't confuse yourself much. Okay. Now, what type of question they will ask in exam? They will ask you an Indian company issuing funds outside India, and what are the things to be kept in mind. So you should know what is the cost of one GDR or one ADR, depending on what number they give. One GDR will be whatever is the market price per share, like Infosys 2000 rupees into number of shares divided by, because you say $1 equal to 60 rupees, so this rupee will be right hand side. So to convert into dollar terms, you divide by the exchange rate, you divide by the conversion rate. So this will give you 1 GDR expressed in dollar terms. Then they'll ask you how many GDR to be issued, number of units to be issued, number of GDRs to be issued. In that case, you are going to do issue size divided by 1 GDR. It's like total amount divided by per unit will give you number of units. But sometimes what will happen on the issue size, there will be issue expenses. They say we want to raise the 10 crore, but issue expense only will go for 1%. So if I raise 10 crore, 1% will go off. I need 10 crore. So issue size will be, or whatever the amount required, this issue size. Or if amount required will be more, then you should do amount required divided by 1 minus expenses, initial expenses in percentage. So this will give you the issue size, then divided by GDR. 1 GDR will give you the number of units. Then they'll ask you cost of GDR. Cost of GDR. This you should use dividend discount model, which means a dividend at the end of the year divided by whatever 1 GDR equals the cost per GDR, plus growth rate. And dividend also, please remember, you should take the dividend per share into number of shares divided by exchange rate, because it has to be expressed in dollar terms. And 1 GDR is what is cost of 1 GDR. 1 GDR means this, cost. This is 1 GDR, whatever, 1 GDR price, the price of 1 GDR. Price of 1 GDR. So dividend divided by price of 1 GDR. This is the formula, you know, right? Cost of equity equals D1 by P0 plus G. The dividend discount model simplified like this. You would have learnt even in IPC level. D1 by P0 plus G. Dividend expected at the end of the year divided by current market price plus growth rate. Same thing you do for ADR, GDR. Okay, so this is what you will get, one type of problem that is on ADR, GDR problems. Okay. Second type what you get is foreign company coming into India. Foreign company coming into India. Okay. Now in this type of questions what you have to do is it's purely capital budgeting problem. So what type of question you'll expect here? They will tell you we are having very good response from the products which we are selling in the India. So should we continue to import from our country? I mean, should we continue to export from our country to India, or should we start a unit in India itself? So the problem will be, or options will be, two varieties. That is continue to export to India, continue to export. For example, we import a lot of clothes, let's say imported clothes, Nike or this Reebok or shoes, all those things. So one, they can keep on importing it. They can have their stores, manufacturing units in England, in UK and all, or in US. Or they can come to India, start like FDI. They start a unit in India and start selling in India. So when it's continue to export, other is start a subsidiary in India. So what you should do is you have to calculate sales here, continue to export. If you do it here, obviously if you come to India, if you start a subsidiary, you'll have more number of units, you can sell more. Selling price per unit may be same, that will be important. Selling price per unit will be same, selling price per unit will be same. But because the selling price, customer will not know whether it's manufactured in India or it is imported to India. They will just know, okay, this is what is from this brand. That's what is important. So selling price per unit will be same, but number of units will be different. You subtract a variable cost, you subtract a fixed cost, you subtract a depreciation, you get cash flow before profit before tax, you subtract tax, you add depreciation, then what you get under two situation is cash flow after tax. And we don't take individual cash flow after tax, we take incremental cash flow differential after tax. This is CFAT, incremental cash flow after tax. But to start a unit in India, we'll also have to have a investment. So you will have a, like a purchase of machinery, purchase of plant. So you will have an initial investment. So initial investment to start a subsidiary in India, how much machinery cost, plant cost, like that, and incremental cash flow after tax. But incremental cash flow will be every year. So to bring it to present value, I multiplied by annuity factor. This will give me present value of all inflows. So initial investment will be outflow. Present value of inflows. Net I'm going to calculate NPV. And here one more thing to be kept in mind. Now here initial investment you will have, therefore you will have some terminal investment as well, terminal cash flow. And I always tell you, when the problem is bigger, remember three aspects: initial cash flow, interim cash flow, terminal cash flow. Initial, what happens at the beginning, IIT, what happens at the beginning, initial, what happens during the project is alive, interim, here I am calling it as incremental, and terminal cash flow. What is terminal cash flow? When the project is completed, initial investment you will have. So for initial investment you will have scrap value, the if the asset is there, machinery, plant, building and all, scrap value will be there. So that should be multiplied by discounting factor. Why discounting factor? Because that comes only once. So we have initial investment. This is one cash flow. This will be outflow. And we have present value of inflows, which is the incremental cash flow present value, and terminal cash flow, this one, which is scrap value into discounting factor. When I multiply by discounting factor, also I get present value. And here is what I get: NPV. And you know the decision: if NPV is positive, project should be accepted. If NPV is negative, project should not be accepted. In this course, few adjustments will come. One of them is working capital. Now, working capital is also an investment because amount is blocked when the project is alive. Therefore, initial investment, along with that, you should also take investment in working capital. Investment in working capital. Amount is blocked. You take an investment. And when the project is completed, you will recover that money fully, not like a scrap value. Therefore, when you say terminal cash flow, this will be scrap value plus working capital recovery. Working capital recovery. So when you invest in working capital, it will be an outflow. And when the project is over, the working capital will be an inflow. This is actually, you don't lose anything, right? See, this is, for example, minimum bank balance to be maintained. You will have a bank account. You have to maintain a minimum bank balance. So in that case, uh, they will tell you have to maintain 10,000 rupees. So when you open an account, you have to keep 10,000 rupees with them. For example, current account. It does not earn an interest also. And when you close the account, the 10,000 you can withdraw. So as long as the account is alive, As long as the project is alive, that current account 10,000 minimum balance is actually not going to give any benefit. You lose the opportunity cost. So in the initially the 10,000, when you open an account, you have to give. It does not generate any income, any interest, and when the account is closed, that amount you withdraw. That is what exactly happens in working capital. When you start a project, you keep the money for day-to-day purposes, working capital investment, and when the project is over, that will come to you as a recovery. Effectively, you lost time value of money, but we don't want to do any shortcut calculation. So initial cash flow, working capital will be investment, will be outflow, and on terminal cash flow, the question may not specify, but it is understood that the working capital, when the project is over, working capital will be recovery, full amount. Whatever you invested and plus additional investment if you made any, exact amount you get, no scrap value and all. But initial investment is in present value terms. But terminal cash flow is in future value terms. You should multiply by discounting factor. So what do I do? Scrap value is terminal cash flow. Recovery of working capital, implied adjustment is also terminal cash flow. So both of them put together, I multiply by discounting factor, I get present value. And one more thing they will have to keep in mind, the working capital, you should take only incremental investment. Recovery also incremental. Why incremental investment working capital? You're already doing some export in India. You have some working capital, let's say 20 crores. Now, when you start a unit in India, you require 50 crores. So, you will not have both, right? You will not be doing export also. You will not be doing subsidiary production also. So you need only incremental working capital. So initially also you take incremental working capital, and on terminal also whatever the same thing will be working capital recovery. And if NPV is positive, the project should be started in India. Subsidiary should be started in India. If the NPV is negative, then don't start a subsidiary in India. Continue to export and make profits and make cash flow based on that. Okay, this is one variety of question you will come across. Foreign company coming into India. Then you have one more variety of foreign company coming into India, but one more variety. Okay, this is also situation, foreign company coming into India, but where they are the holding company, the foreign company will be they are the investors, means they are the holding company as well as customers, as well as customers. So what are the two choices they will have in this type of variety of problem? They will have two alternatives. One alternative is produce in their country. For example, I'll take US as the example. Produce in USA and sell in USA. They are only produce, they are only sell. Or second alternative, what you have, you start a company in India, produce in India, and then sell in USA through export. Sell in USA. So obviously, wherever your profit is highest, that you would like to select. Or you see both case you are selling. Uh, so you're only going to calculate wherever production cost is least. That you also you can do anyways. So if you produce in USA, if you produce in India, you can either compare with the profitability terms or you can compare in terms of cost, wherever the cost is cheapest or wherever the profit is highest. Both ways you can make a decision. Okay, so here if you are selling in USA, then you do whatever your sales value minus whatever cost of production. Both are in dollar terms. cost of production. Both are in dollar terms, therefore difference you will get in profit. And these type of questions will be relevant for 1 year only. Okay, now here what will you do? If you produce in India and then sell it to USA, sale value will be in dollar terms. Sale value will be in dollar terms, but the purchase price is not going to be straightforward. Cost of production. This is where you will have some challenge. How do you calculate this cost of production in dollar terms? Because you start a company in India. You understand the process? How, what you're trying to do? Okay, let me just tell you. If you start a company in India, if you want to produce in India, so what you do is you start a company in India. You start a company in India. So if you want to start a company in India, first of all, you have to invest. Correct? You have to invest. You should invest in the capital, cap structure, and machinery and all. You start a company in India, then you produce. Means you pay rent, you pay salary, you pay other expenses like that. And then this you export and you pay tax also. Remember, you export to yourself. Means you pay rent, you pay salaries, you pay other expenses, you pay tax. There will be income tax, there will be withholding tax, there might be dividends, any of those dividend tax. Then you export to yourself. Means from India, it's export. But for you, US person, it's going to be like you have investor and you are also a customer. So this one type of will be there. So the export cost, the export cost at what rate, transfer pricing, what you call the export cost, what you say transfer pricing will be the import cost for US. So this will be the import cost, or for your terminology like a transfer pricing. TP, transfer pricing. I'm sure you must be expert in income tax and all. Import cost, right? For Indian company, it's export. Like they'll tell you cost plus sales also. So you take all the rental cost, salary cost, all other depreciation cost, whatever all the cost, you add some profit, subtract tax, whatever the sale value you get, no, that cost plus profit, if they say the sale value, that is going to be your cost of production. But you are a customer, so you're purchasing this, so cost of production. But you're also investor, so being an investor, you get share of profit. So this cost will be subtracted by the profit or share of profit, whatever profit, as an investor, or dividend as an investor. So you'll get net cost. Cost of production will be the import cost, which is cost plus sales, minus the profit as an investor, as a shareholder, net cost, then sale dollar value, wherever the balance amount is profit. Or you can do profit, one more calculation also. Sale value minus import cost, that is cost of profit, that is a profit from the production, and profit from being investor. So both the profit you can add. Here also what I'm doing, minus and minus of minus. So it will be plus only ultimately. Anyway, so this is one structure of problem which you can expect. Foreign company coming into India, start a unit in India, and you export yourself, being yourself a customer. So the export sales of the company is your import cost. Cost of production will be the cost of export for the company, that is your import cost. But you are an investor also, so you will have some profit, dividends, after all taxes, regular income tax, dividend tax, withholding tax, TDS, after all tax, what inflow you get, profit as an investor, that is your inflow. Cost of production, import cost is outflow, so you calculate the net cost, sale value minus net cost, that profit versus the previous profit, what explained here. You choose wherever the profit is highest. So choose the option with highest profit. Choose the option with highest profit. Okay, so this is another variety of question you can expect from this chapter. Okay, next. Like now we have Indian company going outside India. Indian company going outside India. Indian company starting a unit in USA. Indian company going outside, going to foreign investment. Indian company making foreign investments, not foreign people coming to India. Ultimately, we have to express in straightforward thing. We have to calculate NPV in rupee terms. But we have two routes, two methods to calculate NPV in rupee terms. One method is cash flow in foreign currency method. Cash flow in foreign currency method, method 1. Or second, cash flow in local currency method. That is rupee method, local currency method. Why these two methods will apply, I'll tell you. Logical. First, you are starting a unit, let's say in USA. You go to USA and start a branch. Let's say you start a hotel, you start a restaurant. Now customer will come there, will sit, will they tell you, oh, you're Indian company, you're providing Indian foods, we'll pay you in rupees? No, right? All the transaction there will take place in dollars only. So you will have all the foreign currency investments, foreign currency cash flows, NPV also will be in the foreign currency. So here in this case, your investment, initial investment will be in dollar terms, foreign currency. Interim cash flow will be foreign currency. Terminal cash flow will be in foreign currency. Therefore, NPV, when you consider all of them, investment, interim cash flow, terminal cash flow, investment already in present value terms. Interim cash flow, I'll have to multiply it by annuity factor. That will give me present value. And terminal cash flow, I'll multiply it by discounting factor. I will get to present value. And when I consider all of them, all the things together, that's what I get NPV in foreign currency terms. Then I multiply it by spot rate. That's what we'll get NPV in local currency terms. Initial cash flow in foreign currency, interim cash flow in foreign currency multiplied by annuity factor, you get present value. Terminal cash flow after the project is over multiplied by that year discounting factor, only 1 year. So discounting factor you multiply, you get present value. NPV, therefore in foreign currency terms multiplied by spot rate, you get NPV. What's the problem? Simple, right? There is one catch. What is that one catch? For this discounting factor and annuity factor, you need the rate of discounting, right? You need the rate of discounting, and that should be risk adjusted discounting rate. That should be adjusted rate. Risk adjusted rate. That should be adjusted rate. What is this adjusted rate? An Indian company, an Indian person, remember a starting point is Indian company going outside India. So in Indian person going outside India, final answer has to be from Indian investor point of view. His required rate of return when he is in India and his required rate of return when he goes to US, it will not be same. Why is that? You are an Indian. You deposit money in rupee terms in India, you will have a fixed deposit. How much rate of interest you will expect? FD interest 6%, sir. 6%, 5%, 5.5, 6%. But you go to US and put the FD in US, you put the FD in US, do you think you will expect 6% returns? No, you will expect only 1 or 2%. The risk-free rate in two countries are different. Risk-free rate in two countries are different. So when risk-free rate is different, if you're doing a project in India, suppose you expect 8% return risk-free, I get 6%. 2% extra as a risk premium I expect. Now in US also can you expect 8% return? No, there also same logic should hold good. 2% premium. So if you have 2% FD rate plus 2% premium, 4% you'll expect. Are you getting my points? I'll write for you. So for Indian person, for Indian, when you do this in India, business in India, and you do same business in foreign country, same business in USA, let's say, same business in USA, example I'm giving, the required rate of return will not be same. The required rate of return will not be same. Required rate of return will be different. Required rate of return will be different. What is the logic behind this? Logic I will tell you. Suppose in India, FD rate, I'll say risk-free rate, FD rate is 5%. And you take risk premium in your business. Risk premium for the risk taken. In the business, you take more risk. Suppose you take a 4% risk. So what is your required rate here? Here your required rate will be 9%. Similarly, in US, will the risk-free rate be same? No. Suppose risk-free rate in US is, let's say, 3%. And risk premium is how much? Risk premium will be same because the same business you're doing. So similar risk, business, this is business risk, 4% risk you're taking. So required rate will be 7%. Required rate will be 7%. You understand? That's what I'm trying to tell you. The required rate of return should not be used as it is. If you are doing foreign currency cash flow, you have to adjust the foreign required rate of return. Like this, it should be 7%. In the problem, what they tell? Indian person starting a unit outside India, Indian person, think from Indian cost of capital, he requires 9% rate of return. This 9% should not be used in discounting in foreign currency. You have this concept in FR also, in like lease agreements, even in Index 115, when you do present value, lease agreements, Index 116. If the cash flow in foreign currency, even in impairment it is there. If the cash flow in foreign currency, you should not use the same discounting rate. You should use the adjusted discounting rate. It will not be exactly 7% because of multiplicative model. Always you should do 1 plus 1 plus. Here only I will tell you. What is the formula? 1 plus risk-free rate in India into 1 plus 4% risk premium or whatever it is. Okay, I will give the formula directly. I will not spend time in giving it. So how do you calculate the adjusted rate? I'll write it here. I don't have space here. So this adjusted rate. What adjusted? Exchange risk adjusted rate. Discounting rate adjusted. Exchange risk adjusted rate. Not other risk. Exchange risk adjusted rate. Exchange risk adjusted rate. So it's going to be 1 plus whatever required rate of return. I don't have space here. I'll write in the next slide. So please write it there. So I'll just say exchange rate here. So I'll write here the exchange risk adjusted rate is given by 1 plus required rate of return in India multiplied by 1 plus foreign currency risk-free rate divided by 1 plus local currency risk-free rate. So what in this example, if you apply 1 plus required rate in India is 9%, that is 0.09 into 1 plus foreign currency inflation or interest rate, both are similar, risk-free rate. Foreign US 3%, so 0.03. Of course, you should do -1 divided by 1 plus local inflation 5%, local interest rate 5% -1. So 1.09 into 1.03 by 1.05 -1. You will get 0.0692 or 6.92%. That's what is close to 7%, right? 7 there, 6.92. Why it's not equal? Mathematical model, multiplicative model. If I do simply the risk rate and all, directly you will understand. Okay. And how to remember this formula? Don't think too much. Easy. This is same as IRPT theorem, isn't it? But only thing is, it is reverse of IRPT. I mean, IRPT logically, but mathematically for simplification, it looks reverse. So for memory purpose, for shortcut purpose, think it is reverse of IRPT theorem. What is IRPT theorem? 1 plus local by 1 plus foreign. Put ulta, opposite, 1 plus foreign by 1 plus local. You get the answer. So this first method what we are discussing, cash flow in foreign currency, NPV in foreign currency, investment in foreign currency, everything in foreign currency. But when you do present value, the required rate of return should be adjusted rate. And adjusted rate is calculated like this. This risk-free rate can also be inflation rate. Can also be inflation rate. If you follow purchasing power parity theorem, what it is IRPT, you can also do inflation under PPPT, purchasing power parity theorem. Okay, so this is method 1 where you get cash flow in NPV in foreign currency, and then you multiply the spot rate, spot conversion rate, you will get the NPV in local currency terms. Okay. Now, if NPV in foreign, second method, NPV local currency, everything will convert. See, we have investments in foreign currency, you apply exchange rates. We have investment in foreign currency, you apply exchange rates. You apply exchange rate, you get investment in local currency. You have an interim cash flow multiplied by exchange rates. This is foreign currency multiplied by exchange rate. You get the interim cash flow in local currency, terminal cash flow in foreign currency multiplied by exchange rates. You get terminal cash flow in local currency. Then you get finally NPV, directly if you do NPV in local currency. So it's easy. Easy. What one challenge? What is that? Investment. Okay. Now in investment in foreign currency exchange rate, this is spot rates. This is spot rate because today cash flow, interim cash flow, how do you calculate? Interim cash flow, how do you calculate? Which exchange rate? Interim cash flow is not today. It's year 1, year 2, year 3, year 4, right? Different years. I need a forward rates. And who do you know forward rate in advance? We will not know forward rate in advance. So here we are going to use forward rate using IRPT theorem. We will not know the actual forward rate. So we will do the theoretical forward rate using IRPT theorem. And this also, terminal cash flow also forward rate using IRPT theorem, because risk-free interest or inflation in India, in US, use IRPT theorem. Theoretical forward rate can be calculated using theoretical forward rates. You apply the exchange rates, then you get all things in rupee terms, you get NPV, and here discounting rate need not be adjusted. This discounting rate adjusted will happen only here. In local currency mentioned, required rate of return, no adjustment. Required rate of return, required rate will be discounting rate, no adjustment. Required rate will be discounting rate. You will not have any adjustment here. And ultimately, both NPV should match. Both NPV should match. I would recommend you can go with the second method, but any method you can do. Ideally, some small difference will be there because of mathematical round of reasons. You take more number of decimal, answer will be accurate. But either way, you can follow any two methods. NPV will be same. If NPV positive, project should be accepted. NPV negative, project should be rejected. So, what is the two alternatives? In alternative one, the discounting factor is adjusted. In alternative 2, the forward rate is adjusted. So ultimately you understand the interest rate impact, inflation impact is given. IRPT factor effect given even in first method in the form of discounting rate. So exchange risk is adjusted in the foreign currency method. Here exchange risk is adjusted in discounting rate. Exchange risk is adjusted in discounting rate here, and here exchange risk is adjusted in forward rate. Exchange risk is adjusted in forward rate. So either way, the interest rates in two countries are given effect and NPV is calculated should match in both the cases. Okay, so this is the one more variety which you can see in from this chapter. Okay, there is one last variety. Do you have any doubts in this case? Because this is the most repeated one. This is previous also is repeated one, but this has quite a few calculations around it. That's why logical, if you have any doubts, you can get clarified. Okay. Last variety which you can expect is the surplus fund management or treasury management problems. Surplus fund management problems. Surplus fund management problems. Direct example only I'll give. For example, you have a headquarters, head office in London. Head office in London. Okay, and let's say you are having some dollar surplus. You are having some dollar surplus. So this dollar surplus you can invest in three ways. You can invest in, let's say, they will tell you like you can invest in London. I mean, okay, in London you can invest, means you can invest in pounds, or you can invest in, let's say, USA or New York, that will be in dollars, or you can invest in something like France or Geneva, that is in Switzerland, where it is in euros. So you can invest in any of these things surplus, and ultimately you have to come back to pounds. Why ultimately you have to come back to pounds? Because you are a headquarters in London. So final answer is has to be in pounds. Okay. So if you go for the first option, what you're having now, first dollar, first alternative. Okay. You're having dollar. Now dollar should be converted into pounds. If you want deposit in pounds, then you have to convert it to pounds. So which rate will you apply? You are converting today rate, and therefore you are going to do spot rate, spot sell rate. To be specific, let's say spot sell. Dollar is converted into pounds, and whether it's right hand or left hand side, be careful. Multiply, divide, depending on that, higher rate, lower rate can be confusing. Okay, so now you have pounds with you. This pounds will be deposited, and it will generate, this will deposit and generate pounds deposit rate. So dollar deposit interest, and it will mature at pounds only, of course. Now we want the ultimate answer in pounds, so you express it in pounds. Yes, the final inflow we want in pounds only, so final inflow is in pounds. So this is first alternative. Second alternative, you have to deposit in dollars. You're already having in dollars, so no need to convert. So dollar will be deposited today itself. You deposit dollar, and dollar interest will come, and dollar will be matured. But you can't stop at dollar. You have to convert it into pounds. So how do you convert it into pounds? You are going to use forward rates, forward rate, and forward sell rate, of course, dollars to pounds, forward sell rate, convert to pounds. Then you have the inflow in pounds. Did you get the first method? You are in dollars, you deposit in London, so dollar you convert it into pounds, and pounds you deposit, it will generate interest and maturity will happen. But if you want to deposit in dollars, then what do you do? You're already having dollars, you deposit dollars, and that will get matured in dollar terms, but that has to be converted into pounds. Final answer should be in pounds. Therefore, I'm going to enter into a forward sell rate on dollars. Forward sell rate, I mean forward sell dollars, I get pounds. Forward sell dollar, I get pounds. That is my inflow under this alternative. Third alternative is interesting. I have dollars with me, but I have to deposit in euro. So from dollars, I have to sell, spot sell. I have to sell from dollars, I have to convert it into euros. Then euro deposit will happen. Interest you get. And this will mature at euros, but final answer I cannot keep it in euros. I have to convert into pounds. So from euro you convert it to pounds, it's going to be forward sell rate, forward sell euro, because from euro you have to convert it to pounds, and ultimately you have inflow in pounds. So wherever inflow is highest, that option is selected. Wherever inflow is highest, wherever inflow is highest. Okay, and sometimes will be one more area. They will tell you opportunity cost of dollars, something like that. They will give you, if they give you, For this dollar surplus, if there is opportunity cost, for this dollar surplus, if opportunity cost is there, then you treat like a dollar borrowing. You for solving problem purpose, treat like borrowing in dollar. Treat like borrowing in dollars. So in each option, what will have? Inflow in pounds is okay. Inflow in pounds is okay. Inflow in pounds is okay. In each of the option, you do outflow in pounds. Dollar, you have to repay dollar, and dollar you multiplied by the spot buy rate of dollar. You have to repay the loan using pounds. So you're treating this like a borrowing loan. You have taken a loan in dollar terms. The dollar you convert into pounds after this maturity period in all the three options, and that will be your outflow in pounds. You calculate the net profit, net gain, and wherever gain is highest, that alternative will be your recommendation. So this is one more kind of question that you can expect in surplus fund managing problem. Just be careful about this. If dollar had an opportunity cost, you treat like a borrowing. You treat like a foreign borrowing. Foreign borrowing, what you do, that's the process we will apply. Okay. Okay. This is the overview and different variety of questions that can be asked from this chapter. Very good. And here you should be careful. Sometimes cross-rate prompts also can be there. Just be extra careful. Okay. I hope you got the question. Right Limited has proposed whom? It proposed to expand operation, for which it requires funds of $30 million net of issue expense, which amounts to 4% of issue size. It proposed to raise the funds through GDR issue. It considers the following factors in pricing the issue. Expected domestic price per share is rupees 300, face value 10 each per share. 4 shares underlie each GDR. Underlying shares are priced at 20% discount to market price. Expected exchange rate is 70 per dollar. You are required to compute number of GDRs to be issued, cost of GDR to Right Limited, if 20% dividend is expected to be paid with a growth rate of 20%. Okay, just read the problem once more. Okay, two things they're asking. One, number of GDR to be issued. Let me give the heading. First part of the question, number of GDR. Number of units, number of GDRs. And second part of the problem, cost of GDR, like cost of equity, cost of GDR. Okay, number of GDR, how do you calculate? Number of GDR will be calculated by whatever the issue size, how much our amount you raise, divided by cost of one GDR, right? GDR per unit. Cost per GDR. Cost per GDR is like total amount raised divided by market price per unit, cost per unit. So number of units will be total cost divided by cost per unit. Issue size, amount raised by cost per GDR. Okay, so we need two things now. I need issue size and then I require cost per GDR. Okay, what is the issue size? Issue size is $30 million. No, you're wrong. Why? Because if you raise the $30 million, 4% will go for the expenses only. Balance some amount will realize, no, I want the balance to be 30 million after taking out 4%, which means if you raise 100 rupees, 4 rupees will go for the expenses, 96 rupee will remain. I want the remaining amount to be 30 million. Therefore, how much should be this? So you do 30 into 100 divided by 96. Or I can tell you the short form, if you want a formula kind of thing, that will be amount required divided by 1 minus issue expense percentage. So amount required is 30 million divided by 1 minus issue expense 4%. 4% means 0.04. So 30 million divided by 0.96. 31.25 million. You can also do 100 required is 30 million into 100 by 96. You get same answer. Okay. Cost per GDR. Cost per GDR. What is the price of one GDR? They said 4 shares underlie each GDR. One GDR equal to 4 shares. So what is the cost per GDR, price per GDR, whatever you call? You have to multiply by 4 shares. So 4 shares into what is the cost of each share? Domestic price of each share 300, but it is not issued at 300. It is priced at 20% discount. So it's 300 multiplied by 20% discount. So shall I say directly 80%? 20% discount. Now this will give me in rupee terms. I need to express in dollar terms. So for that purpose, I will do exchange rate. I will divide by the 70 rupees per dollar. Why I divide? Because this is in rupee terms, rupee 300, but I need dollar terms, rupee right hand side. $1 equal to so much of rupees, rupees right hand side. So you divide. So you get 300 into 80% into 0.8 into 4 by 70, 13.71. 13.71. So what will be the issue size? You require 31.25 million divided by per unit 13.71 divided by 13.71. 2.2794 or 2.28. 2.28 units. Million units. 2.28 million units. Okay. Cost of GDR, that is like cost of equity. What is cost of equity formula or cost GDR formula if you want to write? That is, cost of equity I'll write here for your reference. That is D1 by P0 plus G. Cost of equity, that is. But here it is cost of GDR. So will be dividend for GDR, dividend per GDR divided by P0, market price today. So GDR price plus growth rate. So what is dividend expected? You are going to give dividend per share of 20%. 20% on 10 rupees. So dividend per share 20% on 10 rupees, 2 rupee per dividend, 2 rupee per share, but you will have 4 shares into 4 shares. But this will in rupee terms. I need to convert into GDR terms. How do I convert rupee into GDR? I will divide by conversion rate 70 whole divided by the GDR price, which I calculated to be 13.71 plus growth rate. Growth rate is 20% again, so 0.2. So this 2 per share into 4 share 8 by 70 0.1143 by 13.71 plus point 2083. 0.2083, or you can express in percentage 20.83%. Majority comes from growth rate only. Anyway, so 20.83%. Okay, I'll go further. Okay, so come to this problem now on international financial management chapter. Along with this, we'll get the concepts of international financial management. So basically, what is really difference between foreign exchange risk management chapter and international financial management chapter? In the exam, anyway, it does not make difference because it just comes as an exam. The difference is that in foreign exchange risk management, we talk about individual situations, small positions. But whereas when we talk about international financial management chapter, we talk about two broad categories of problems. One, an Indian company going outside India and do the transaction, in the sense start a entity, or foreign entity comes to India and do the transaction. This is a broad difference. So on those two varieties, we have to do the problems. So this is one of them. Let's do this problem. Please get this problem. A very popular question in exams. It will give you a lot of new concepts and also revision of the concepts you have learned earlier and forgotten. And some costing concepts also, maybe. Hope you got this question. This is the international financial management. Hope you got this one. Shall we read? Quite big one is there, and along with reading, we'll let me explain the concept also. Okay. A multinational company is planning to set up a subsidiary in India where hitherto it was exporting in view of growing demand for its product and competition from other MNCs. The initial project cost consisting of plant and machinery including installation is estimated to be US dollar 500 million. Okay, so this is the problem about foreign company coming into India. And they said initial project cost consisting of plant and machinery is estimated to be 500 million. So this problem is very much like a Capital budgeting problem, your investment decision. Obviously, by now you would understand what would be the requirement of the problem. The requirement would be, should you purchase, I mean, should the investment be made or not by multinational company? In the sense, whether starting this project will be NPV will be negative or positive. That will be the objective. If NPV is positive, the multinational company should come to India. If NPV is negative, multinational company should not come to India. It's a capital building problem. It's an investment decision problem based on NPV. And to compute NPV, I gave you one good technique in bond valuation chapter. Not sure whether you remember it. When too many transaction comes, even in bond replacement decisions, I told you, divide the cash flow into three categories of cash flows. IIT, initial cash flow, interim cash flow, terminal cash flow. What transaction happens at the beginning when you enter into a contract or when you're taking a decision, during the period of the contract is alive, and when the contract is over? Initial, interim, terminal. This is what I have discussed. So keep that objective in mind, keep that process in mind, it will help you here. Initial project cost consisting of plant and machinery, including installation, estimated to be US dollar 500 million. So this is going to be your initial cost, initial cash flow, outflow. Okay. Then the net working capital requirements are estimated to be US dollar 50 million. Okay. Working capital requirement of a project, again based on your IPCC level, past level. Do you remember what is the treatment of working capital requirement? How it is used to be considered in capital budgeting problem, working capital requirement? What is working capital? I know your answer. Sir, current assets minus current liability. That is one. But more importantly, it is the amount blocked and not available for usage. It's the amount available for day-to-day requirements. It's like a minimum balance in the saving bank. You can't use it. You can't take it out. As long as bank account is there, that balance has to be maintained. You can't withdraw. Not available for free use. Similarly, in business also, working capital, as long as the project exists, that working capital also exists. You can't take it out. It's not available for free usage. That's why while computing free cash flow, if you remember, long time back in corporate valuation, for profit after tax, we add depreciation, we subtracted increase in working capital because it is not available for cash flow purposes, the free cash flow purpose. Which means it is to be treated like a deposit. I don't know whether you remember it. It should be treated like an investment, like a deposit. Uh, not a sinking fund. Sinking fund will generate income. Sinking fund is available for all the purposes. It's like a margin money we discussed in futures. You remember margin? What is margin? You deposit the margin. Once the future contract is over, once you do square off, the margin will come back to you. So margin, there is an inflow, and margin, there is an outflow first, and there is an inflow. So effectively, margin is not your cost, but what is your loss there? Remember, with respect to margin, the interest on margin. If you remember, everywhere we take in future, interest on margin is your expense. Margin is not your investment. Margin goes in, margin comes back. Therefore, working capital is like that. But we don't want to take interest on working capital. Indirectly, we know what do we do. When we enter the project, working capital, we treat it as an initial cash outflow, like investment. And when we come back, when the contract is over, we treat the working capital as a recovery of working capital. And we take it in terminal cash flow. So in initial cash flow, investment, full amount. In terminal cash flow, inflow, full amount. But while doing terminal cash flow, we apply discounting factor. But today investment 1 rupee only. So effectively overall, if you look at what you understand, working capital, initial investment full amount, and on the end of the project you recover the working capital full amount, but that will be done present value to compute NPV. So one inflow and outflow, but while doing outflow full amount, but while doing inflow you take the discounting factor. So effectively what is the impact? The time value of working capital. That is what the overall concept is. But what to be kept in mind, working capital is part of initial cash flow as investment. Working capital is part of terminal cash flow as recovery. That much you remember sufficient. Initial cash flow, investment. Terminal cash flow, recovery. Ideally, I should not explain you all these things. These are a part of your IPC level capital budgeting. You are in great detail. Anyway, the company follows straight line method of depreciation. Presently, okay, straight line method depreciation will come in for every year. You have to compute profits, annual profit, annual cash flow. There it will have an impact. Company is exporting 2 million units every year at a unit price of $80. At a unit price means the sale price. At present, the selling price is $80 and variable cost per unit is $40. So I hope we are understanding situation in this problem. You are an MNC company. You are in, let's say, US. Everything US dollar terms, you are in US. You are exporting the goods to India. India is importing. Indians are importing. You are exporting the goods to India. But in India, lot of competition is there for that product. So what you're planning, instead of manufacturing in your own country and then exporting it to India, why don't you come to India and then sell it? Understanding? Instead of you existing, selling it yourself, you manufacture in India and then sell it to Indians. Why you manufacture in US, then come to India and then sell it? You manufacture in India and sell it to Indians because there is a growing product. There is a huge demand for that product. And in that sense, at present, your selling price is $80 for a product and your current manufacturing cost, variable cost, $40. The Chief Financial Officer has estimated the following operating cost and other data in respect of proposed project. Okay, in the project, what are the expenses you will have? Variable operating cost $20 per unit. Very good. If you manufacture in your own country, you have to pay $40 per unit. Variable cost. If you come to India, it will only be $20 per unit. Amazing. Additional cash fixed cost will be 30 million per annum. Additional cost per annum. Very good. This is important one. Please read carefully. Project's share of allocated fixed cost will be 3 million per annum based on the principle of ability to share. Read this line once more. Project's share of allocated fixed cost will be 3 million per annum based on the principle of ability to share. What do you mean? What do you understand? What should be the treatment? Simple line. This should be ignored. This should not be considered. Your costing concept, relevant costing. Common cost should not be considered for decision making purpose. Why? Let me give an example. You 4 friends, or let's say you 3 friends. You 3 friends have wanted to go to some trip. You hired a car, and the car rental was 12,000 rupees. 3 people. So 12,000 divided by 3, 4. You did 4,000 each. Now in the last moment, one more person came. So still car had the space. You said, let's accept it. Now 4 persons are there. 12,000 you have to pay. So how much per person comes to now? 12 by 4, 3,000 each. He could share the cost. Now, if you think from the trip cost point of view, rental point of view, from that vehicle point of view, what was the overall cost when 3 people was there? 12,000. Now, what is the overall cost? Now, when four people are there, 12,000. So, is there an increase because one person came? Other things may increase, variable cost may increase, but this fixed cost, it does not change how many ever number of people will come. There are some fixed cost which will increase. That's why I said additional cash fixed cost 30 million to be considered, but based on the principle of ability to share. So what the MNC will do, I have 20 subsidiaries. Now you one more joined, you also take a share. So per company it might have an impact, but overall it will not have any impact because the entity, the group as a whole, total will remain same. Like the example I gave you, divide by 4 subsidiaries or divide by 3 subsidiaries, the total cost will remain same. See, for all legal purposes, your transport costing, transfer pricing, everything, you will have the cost. But for decision making purpose, whether to start a unit or not to start a unit, from the point of view of the group, whether to start a subsidiary or does not start a subsidiary, in both the cases, overall cost for the group remains same. So based on the ability to share, we will not consider, we will ignore. We will ignore. Production capacity of the proposed project in India will be 5 million units. Here again comes the interpretation. Plant capacity 5 million units, but presently you're selling 2 million, right? You're selling 2 million units every year. So should I take 2 million or 5 million? So our plant capacity is 5 million, where it is given the problem that they produce full capacity. We have to assume basics. In view of growing demand, there's a huge demand for the products. You're already selling 2 million. If you come to India, you can sell more. How much sell more? We don't know. Our capacity is 5 million. Let's produce up to the capacity. So you have to make a assumption, interpretation. Because of the growing demand, it is assumed full capacity is utilized. So we'll take 5 million units. Don't do your law interpretations. They said only production capacity. They have not told actual capacity. SFM, interpretation, circumstances, growing demand. So we'll have to interpret that entire capacity is being put to use. So 5 million units. Expected useful life of proposed plant is 5 years. Okay, this 500 cost what we have, we will depreciate it over 5 years, no salvage value, and also they said straight line depreciation. So we can simply divide by 5. Existing working capital requirements of the production and sale of 2 million through the export was 50 million. Okay, this is interesting. 15 million. Existing, you wanted how much working capital requirement? Working capital requirement is 50 million. You want for this project. But if you come to India, your existing plant need not function for this. Your existing working capital can itself be used for this new project, which is 15 million, or the working capital which you're using for this unit will get released, will get freed up. You can use it for the working cap requirement of 50. So that 15, you can use it as a part of 50. So additionally, how much you require is only going to be differential amount. So working cap requirement of this project 50. But for this project in your existing situation, you are already using 15. So that will get released. That can be made use for this subsidiary. So incremental working cap requirement will only be 35. Now one question arises. When we close this thing, that is life is 5 years. After 5 years, after the project, will 50 come back or will 15 come back? Definitely 50 will come back. But we are discussing incremental cash flow. We are comparing two situations. Means what? If you start a unit in India, if you don't start a unit in India, what is the incremental cash flow? If you start a unit in India, how much working capital will come back? 50 million. If you don't start a unit, then also 15 will come back. Because 15 is already existing. That 15 will definitely come back, which is in present use. So on an incremental basis, it is still 35. Initially also incremental is 35. Terminally also it is 35. But initially it's outflow and terminally it is inflow. Export of the product in the coming year will decrease to 1.5 million units in case the company does not open the subsidiary company in India in view of the presence of competing MNCs that are in the process of setting up their subsidiary in India. Presently, you're selling 2 million units. You're planning to start up subsidiary. But if you don't start the subsidiary, this will not be 2 million units. It will come down to 1.5 million units. Now the question is, should I compare 2 million units with the option of existing with the option of starting a unit, or 1.5 million units with the objective of starting a unit? We should take 1.5 million units because it's all incremental basis. Start a subsidiary, what is the situation? Don't start a subsidiary, what is the situation? If you start a subsidiary, you will be able to produce and sell 5 million units. If you don't start a subsidiary, you are selling 2 million in the past you forget what is going to happen. That's what we are comparing. You can sell only 1.5 million units. So effectively I can say you can sell 3.5 million units more, but I can't use calculation 3.5 directly because the expenses cost are separate. But quantity wise the incremental sales for you will be 3.5 million. Or I can also say the 1.5 million is like an opportunity cost. Even without starting a unit, I'm still be able to tell 1.5 units, million units. Now, because of starting a unit, I can sell 5. So, how much incrementally I can do? 3.5. Quantity wise, not the value wise. Value wise will come to it separately. So 1.5 million units, we treat it like an opportunity cost. So we should consider only incremental effect for computing cash flow as well as for quantity. But we don't do it in quantity basis, we do it on cash flow basis. But for conceptual purpose, I told you for quantity. So existing, I mean, if you don't start a unit, it will become 1.5. If you start a unit, it will become 5. So we should worry about the incremental portion. Applicable corporate tax rate 35%, required rate of return 12%. Assuming that there will not be no variation in the exchange rate of two currencies and all profits will be repatriated, as there will be no withholding tax, estimate the NPV of proposed project in India, present value of interest factors for 5 years given below. Okay, that's all. 5 years present value interest factor is given. 5 years is the project life, so 5 years is given. Okay, before I go further, on the explanation we have discussed so far, any doubts on the point? Then we'll compute in numbers. Why 1.5 million instead of 2 million? Because 2 million was the past. We are not looking at the past. We are doing decision making. What decision we are doing? Start a unit, don't start a unit. If you start a unit, you will be able to sell 5. If you don't start, they said you can only sell to 1.5 in case the company does not open. So when you're talking about future, between two options, starting a unit, don't start a unit, it's between 1.5 and 5, not 2, because 2 is the history, past, that's gone, you forget. Going forward, only we look. If the 1.5 information was not given, I would have taken 2 million. Why? Because history is assumed to be repeating in the future when no information given. So if 1.5 is not given, I would have taken 2 million. Okay. Hope the other concepts are clear. Main concepts in this problem are three. One, working capital. Second, the common cost. And third, this 1.5 million units. These are the three critical areas in this problem. Working capital, the common cost, shared cost will not affect. And third, the 1.5 million and not the 2 million. Okay. I hope it's fine with you. Uh, so let's write it down like what we do: initial cash flow, interim cash flow, terminal cash flow. You can write later. I'm just giving you an idea. Initial cash flow, investment, cost of plant and machinery 500, everything in dollars only. We'll keep it in dollars. Working capital 50, release of existing working capital 15. So increment only 35. So total I can say 535. Please write it. So plant and machinery 500, working capital 50, release of working capital 50. So incremental 535. So 500 is the cost of machinery. This 35 is the incremental working capital. Remember, working capital adjustment very important. It will come in initial investment as a part of outflow, and it will come in the terminal cash flow as recovery. Many times people will not do in terminal because question did not say. No, that is assumed. That is a concept. Working capital will be recovery in the terminal year. Will be available for other purpose. It will get freed up basically. It's like closing a bank account. So minimum balance will now become available. So cost of machinery 500, working capital increment 35. So initial investment 500 plus 35, 535. Interim cash flow in India, you'll be able to sell 5 million units. 5 million multiplied by selling price 80. Selling price 80, so 400. And in India, the cost of production came to only $20 variable cost. 5 million into 20, 100. Additional cash fixed cost 30. And remember, the shared cost based on the principle of ability to share common expense ignored. In the exam, should write a note on all those things. Why you ignored? Depreciation, no salvage value. 500 is the cost minus no salvage value divided by useful life. 500 minus 0 divided by 5. Original cost minus salvage value divided by useful life. Straight line method of depreciation. 100. The common cost is not considered based on the principle of ability to share, not relevant for decision making. You get profit before tax, subtract tax, profit after tax. We need cash flow. So what we should do for this? Working capital don't adjust. That's only beginning. No increase in working capital after that. We have to add back depreciation. Correct. Okay, let's add back depreciation now. You get cash flow after tax. Now this cash flow is from selling 5 million units to 10.5. Hope everybody getting same answer. Now, we are not looking at just starting a unit. We are comparing with existing transaction. Existing, you're able to sell 1.5 million units. From that, how much cash flow you can generate? We want only additional cash flow, incremental cash flow, right? So, how much profit from the sale of 1.5 million units? If you don't start a unit in India, that will be like an opportunity cost. I told you 1.5 million units. Directly, we don't take 3.5 because the cash flows are different, but impact is same. We will take sale revenue from 1.5 million. If you don't start a unit in India, you will be able to sell 1.5 million units still. So that is our opportunity cost. If I subtract that from the existing cash flow, what we calculated, that will get you the incremental cash flow for starting the unit. 1.5 million into $80, 120. Subtract variable cost, 1.5 million into 40, you get 60. The profit before tax, you get 60. The variable cost is different. Sale price is same only, 80, 80. Sale price does not change. But variable cost change. Variable cost 20, variable cost 40. Fixed cost, no information, so we'll ignore. Tax rate assumed to be same. You get the cash flow after tax. No fixed cost, no depreciation. So nothing to add back any depreciation in this case. So here we get 210.5. Here we get 39. So incremental basis, net cash flow 210.5 minus 171.5. 210.5 minus 39. 171.5. Cash flow, if you start a unit, every year you get 210.5 million. If you don't start a unit, still you get 39. So what is the cash flow attributable to starting a unit? Incremental 171.5. Net cash flow difference, incremental cash flow. If you start a unit in India, you get 210.5. If you don't start a unit in India, you still get 39. So how much is the differential cash flow because of starting a unit? Incremental cash flow 171.5. Okay, now this is every year cash flow, but we have to bring it into today terms cash flow. Today terms means we need to do discounting factor, but this every year cash flow is same. So 5 years we can multiply it by annuity factors together directly. Instead of doing one by one, directly we can multiply it by annuity factors for 5 years. Every year cash flow is same, so we can make use of annuity factor. Discounting rate, they said 12%. Project life 5 years. I hope you know how to calculate annuity factor. 1 divided by 1.12 equal to 5 times GT. Or they've given the every year discounting factor, present value interest factor, PVIF. You can do sum of it. Sum of discounting factor is called as annuity factor. Remember, all these are incremental basis. Incremental initial investment. incremental interim invest cash flow, and incremental terminal. Everything incremental. I'm not written in the columnar format, but if you remember what you have done in one bond replacement problem, old bond replaced with the new bond, then incremental. We had three columns. Like that, here also you can do three columns: start a unit, don't start a unit, incremental. But I'm not doing that. I'm writing the last column directly. Hopefully, you'll be able to understand, because otherwise, it will be too many columns. I'll not be able to fit it here. But structurally, keep it that in mind. Start a unit, don't start a unit, incremental. Okay. Now, terminal cash flow will be two cash flows are there. One scrap value will come, other working capital will come. Now, how much scrap value? How much working capital? Scrap value, they said 0. Nothing will come. Leave that. What about working capital? Working capital, should we take 50 or should we take 35? This project wanted 50, sir. Out of that 50, existing only we had 15. We made use of it. So additionally, we invested only 35. But total investment is 50. Now, how much will come back after the 5 years? So 50 will come back. 50 will come from this project. But think from a 3 columnar basis, incremental basis. How much will you recover from this project is 50. Had you not started this unit, still you would have recovered 15 once the project is over on a comparison basis. So 50 is starting a unit, 15 recovery. If you don't start a unit, incremental of 35. Again, the 3 columnar approach should give you the clarity. And this will come after the end of the project life, which is after 5 years. So apply the discounting factor, like a redemption price what we used to have in bond valuation. Apply discounting factor, you get the present value. Then you calculate. 535 is this is in outflow investment. 618 is inflow. Present value of inflows, present value of annual cash flows, and 19.86 is also one-time inflow. So total, what is the net amount? NPV. That comes to 103.08. 103.08. 103.08. 103.08. 103.08. And then say NPV is positive. So project is financially viable. NPV is positive and the project is financially viable. Project is financially viable. Financially viable. So if you see, this problem actually nothing to do with Forex. Everything is only with respect to capital budgeting chapter. But this is one repeated question in examination. I hope you got this one. What about required rate of return? No, that's what you have taken as discounting rate. No, not required. That's capital budgeting basics, right? Required rate of return is the cost of capital. We use it for discounting rate. That's all, nothing else. You don't write a note on that. Okay. Now let's take up this problem. This is going to be reversed now. Meaning, Indian company going outside India. Indian investor going outside India, and how much return does he get? That one. Let me just do a quick recap and then apply on this problem. Hope you remember how the return for Indian investor, return for Indian investor in foreign, an investment in foreign currency, return for Indian investor for investments, for foreign investments, for foreign investments. Do you know? Do you remember the formula? We have discussed also, but anyway, return for Indian investor, when Indian goes to outside India, let's say invest in US, he gets US security. He gets return of US security return, as well as he gets it in the form of what? He gets it in the form of currency appreciation. So let's say 5% he gets by way of the income, and 2% he get by way of dollar appreciation. His total will be 7%. The currency appreciation plus the return from the foreign currency terms. But we don't do plus. We follow multiplicative model. So how do we do? We do 1 plus the returns in foreign currency. I'll say dollar terms for simplicity sake. 1 plus dollar return percentage multiplied by 1 plus dollar appreciation. Correct? And this is the return from the Indian investor point of view. So if Indian investor should be indifferent, IRPT theorem should be indifferent, that means these two should be equal. I mean, I should do -1 here actually, because I'm talking about Indian investor. Okay, from Indian investor, what do you get? If investment in India, what will you get? Or let me do one thing, I'll write once more. I'll write for Indian investor investing in India and investing in this problem, let's say I'll say US. Okay, now investing in India, I'll do multiplicative model. What will be return? 1 plus return in rupee terms. Correct? And here, what do we get? If it is invest in US terms, means what do you get? If you invest in US, 1 plus return in dollar terms plus, 1 plus currency appreciation, dollar appreciation. Okay, now dollar appreciation means dollar is trading at premium. How do you know how much currency is expected to increase by? Do you know the concept? IRPT theorem we discussed. Dollar appreciation means we calculate by IRPT theorem formula, that is 1 plus local rate divided by 1 plus foreign interest rates. Okay, now I'll apply on this problem now. Now investing in India, how much return you get? Read this problem. I hope you got this question. Okay, this local rate, I'll just make it as rupee, so it'll be more clear. 1 plus rupee rate divided by 1 plus. I'll explain the concept also, formula also. First, I'm giving you overview. 1 plus the dollar interest rate. Okay. Hope you got the question and write down till here. Okay, hope you got it. Are you able to understand the overall concept? For Indian investor, if you invest in India, you get the answer in rupee terms. If you invest in US, how that's going to be obtained should be similarly 1 plus dollar terms and currency appreciation. Currency appreciation means what? Same as your IRPT formula. 1 plus local rate by 1 plus foreign rate. Everywhere we are doing 1 plus 1 plus because we are following multiplicative model. Hope you are with me on this one. Okay. We'll apply in this problem. I'll explain one more logic after that. How much in rupee terms you need to get in this problem? Hope you got the question. Please confirm. Risk-free rate in US 4%. Same in India 8%. Required rate of return on this project is 10%. Computer risk adjusted dollar rate of return. Okay. Now rupee terms. Rupee terms means in this project. Rupee terms in this project. And dollar terms in this project. 4%, 8% are interest rates. That for this, for currency appreciation. Okay. Now, if you invest a project in India, that project should give you how much return? The project should give you 10%. So 1 plus 0.10. 1 plus 0.10. Let me do one thing. Before I explain this, let me give you logic once more. Then I'll come to this multiplicative model. First, let me give you conceptually on a additive model. Then I'll come to multiplicative model. Okay. In the same example, I'll take. Okay, in US, in India, and US. What is the interest rates? In the Indian currency, interest rates is 8%. US is 4%. And what about the project? Like a business, like an investment. In India, you require 10%. Now, please tell me logically, interest rate, let's say risk-free rate, right? Risk-free rate. Risk-free rate. Risk-free rate is 8% in India. But if from this project, you're expecting 10%, why are you expecting more? What do you call that difference? Remember, simply, I don't want mathematically, simply, why are you expecting more return than risk-free return from your project? You might do cement, steel, consumer goods, shipping business, anything. Risk-free rate is 8%, but from this project in India, you're expecting 10%. Why are you expecting more return? Because of risk. Correct. What do you call that? This higher amount is because of risk. So what do you call that? Yes, risk premium. Risk premium for the project is 2%. Beta and all will come when you want to measure, but this is higher risk. Your beta is a measure of risk, but here we're talking about return. So beta will not come here. Beta is for measure of risk. Here, because of risk, we are expecting return. We are talking about the return part. So 8% risk-free rate, but you are expecting 10% risk premium over and above risk free rate. Why? Because my project is riskier. I expect more return. Fine, 2%. Apply the same logic. If the same project is done in US, same logic you should apply. So if I apply risk premium, how much I should expect in US? 2% premium means my expectation in 6%. What do you mean by this? The business in I mean the if business done in India, if the business is done in India, then required rate of return from this project is 10%. If business is done, same business is done, if same business is done in USA, then required rate, equivalent required rate of return, equivalent required rate of return is 6%. 6%. So why this is required? An Indian person will be calculating NPV. Now, while calculating NPV, how does NPV will be calculated? NPV will be calculated by considering if I start a unit in USA, I get the sales in US, I get the expense in US, my profit is in US, my cash flow is in US. That cash flow dollars should be converted into present value terms. For present value purpose, I should not use discounting rate of 10%. I should use discounting rate of 6% if I'm discounting dollar cash flows. Of course, I will have dollar cash flows only every year, right? I'm having a unit in USA. So when you discount the dollar cash flows, I should use 6% as discounting rate, not 10%. And again, mind it, this is not a perfect 6%. This is a additive model, but to get the accurate answer, we should go for multiplicative model. But anyway, but first you take down this part. Hope you got the concepts. Similar concept you will have in your FR also. You know, while doing impairment in days 36, AS 28, you have to calculate the present value of cash flows from that asset. If that asset is situated outside India, your inflow will be in foreign currency terms. When inflow in foreign currency terms, when inflow is in foreign currency terms, the required rate of return for rupee should not be used for required rate of return dollars. Why it should be different? The risk premium is different. So what you expect if it was rupee cash flow will not be same for dollar cash flow. We have to calculate this equivalent rates. We have to calculate this equivalent rates. Hope you got the concept. You are thinking about Indian person going outside India to compute the required rate of return in dollar terms. To compute the required rate of return in dollar terms. What we should do? We should recalculate the required rate, applying the risk premium. And why it will be different? Because the risk-free rate in two countries are different. Therefore, required rate of return also will be different. Okay. Now, let's come back to this one. Multiplicative model, what we are doing. Let's calculate and let's get the accurate answer. Then for this, I'll give a formula. Let's apply it. So 1 plus 0.1, required rate of return in rupee terms. In US term, dollar terms, how much is, that's what we are calculating. 1 plus dollar terms returns. into 1 plus rupee rate. Rupee rate is 8%, 0.08 divided by dollar rate, risk-free rate, 1 plus 0.04. Cross multiply 1.1 into 1.04 divided by 1.08. Then 1 comes left side, minus 1. So dollar terms expectations. How much you get? 1.1 into 1.04 by 1.08 minus 1. 0.059 multiplied by 100. 5.9259%. 5.9259%. You see, approximately 6%. Not exactly, because of mathematical reasons. So we have to use this formula to get the adjusted expected rate of return. Risk adjusted, exchange risk adjusted rate of return. I'll give you formula also, don't worry. Where is risk adjusted? This is the risk adjusted, no IRPT theorem formula. Risk-free rate we are taking. Risk adjusted means exchange risk. That's the risk we are talking about. Risk adjusted means exchange risk, that's implied. Exchange risk adjusted dollar rate of return. And how do you adjust for exchange risk? IRPT theorem. So when I take the dollar risk-free rate and rupee risk-free rate, the IRPT theorem concept is applied. So that's how the exchange risk element is brought in this formula. Anyway, let me give you the formula. And there are two ways of getting the answer. Later for cash flows, I'll come to that. Taking this example only, I'll do it. Okay. Hope you're done till here. Okay. I'll give you the formula now. Let's write down exchange risk adjusted dollar return. What do you mean by this? The required rate of return for required rate of return for cash flows in dollar terms. Formula is given by 1 plus required rate in India, or required rate of return of the project, when required rate of project in India, required rate of project in India, whole multiplied by 1 plus risk-free rate in foreign divided by 1 plus risk-free rate in India. Is actually the formula will be reverse of IRPT. So required rate of return of the project in India is 10%. So 1 plus 0.1. And risk-free rate in foreign country is 0.04. In India, it's minus 1 you should do. Sorry, minus 1 you should do. Please don't forget overall minus 1, because minus 1 only, then you get the rate. Otherwise, it will be 1 plus only. 1 plus the risk rate in India, 0.08. So 1.1 into 1.04 divided by 1.08 minus 1. So same number you get, 0.059259. That is 5.9259%. What do you mean by this? 10% in rupee terms is equal to 9.529% in dollar terms. So cost of capital or required rate of return, discounting rate, whatever you call it, cost of capital, discounting rate, required rate of return. If you are using in rupee cash flows, it is 10%, which is equal to, this is for rupee cash flow. If you are doing dollar cash flow, then your discounting rate is 5.9259%. Only if you do this, same answer will get, otherwise different answer will get. Anyway, so if your cash flow is in rupee terms, 10% discounting rate. If your cash flow is in dollar terms, 5.9259% discounting rate. Okay, now let me take one simple numerical for this, then we take the full-fledged problem. Hope you've taken down, hope you understood the concept. If your cash flow is in rupee terms, that is in India, risk-free, the required rate of return is 10%. If the same project is done in US, then equivalent is 5.9259%. If I write 6%, you get 0 marks. We don't do additive model, we have to do multiplicative model. And you get the answer very easily. Where this formula is applied, where this concept is applied, you just get the answer. So use that 6% for verification purpose, risk premium method. Don't use it for solution method. And when the rate of interest is high, you are going to have a higher difference, so not recommended. Okay, hope you got it one. For this example only, I'll take one simple numerical. Suppose for simple example purpose, one simple, take a 1 year project example, 1 year project only. Investment, let's say, is $1,20,000, $1,00,000, let's say, and inflow after year one, let's say it is $1,10,000. Simple example I'm taking. So how should you do it here now? Investment $1,00,000, inflow after year one $1,10,000. NPV calculation. How do you calculate NPV calculation? Initial cash flow is $1,00,000. Interim cash flow and terminal both are same. In this case, interim and terminal both are same because only 1 year. Interim cash flow, terminal cash flow, both are one same only. We are having $1,10,000. But $1,10,000 is after year one. You want today. At what rate will you discount? Please tell me. At what rate are we going to discount? We discount at this number 5.9259%. We'll discount at 5.92%. So 1 divided by 1.059259. So how much you get? The initial cash flow was 1 lakh. Okay. 4 decimal if I take, or you can multiply whatever it is. Both ways fine. So 1,10,000 into 1 by 1.059259. 103,846, right? Approximately 103,846 dollars. So what is NPV? Uh, 3846. Inflow is so 3846 NP dollars NP 3846 NP. But dollar term. But we are thinking Indian point of view. Convert it, let's say spot rate given to be is 50 rupees for simplicity sake. Suppose spot rate is rupees 50 for easy calculation. This is NPV in dollar terms. So what is NPV in rupee terms will be 3846 multiplied by 50 rupees. One lakh 92 300, right? 1 lakh 92 300. Okay, I explained so much, very good. But I'm going to teach you now how to calculate this without this method. In the exam, we can actually follow that and we recommend that. Anyway, I'll come to that. This is one alternative where we calculated the cash flow in dollar terms, and while discounting the cash flow in dollar terms, a different discounting rate to be used, recalculated 5.92. If cash inflow in dollar, respective required rate of return should be there. Whatever required for Indian investor cannot be used. It has to be adjusted. That's why it's called as adjusted rate of return. And what for adjust? Risk adjust. Which risk? Exchange risk. Exchange risk adjusted rate of return. 5.92% we have used. Alternatively, what do? Convert everything into rupee terms. Convert all the cash flow into rupee terms. In that case, what will happen? We can discount using 10% only. Okay, let's do that. Initial cash flow in rupee terms, we had $1 lakh multiplied by rupees 50. You get rupees 50 lakh. Interim cash flow terminal both are same. Interim terminal both are same. Here is a problem. $1,10,000 you will be receiving after year one. After year one. But what is the exchange rate after year one? We know only today rate, right? Spot rate 50. After 1 year, we don't know the rate. What do you think we can do? What do you think we can apply to get the rate after year one? To get the forward rate. IRPT theorem. Use the risk-free rate of interest. Forward rates. Using IRPT. What is IRPT formula? 50 into 1 plus local interest rates, which is 0.08 divided by foreign inflation, 1 plus 0.04 foreign interest. So how much you get forward rate as? 50 into 1.08 divided by 1.04. 51.9231, right? 51.9231. 51.9231. Okay, multiply now. $1,10,000 into 51.9231. $1,10,000 into 51.9231. 57 lakh 11,541 rupees. 57 lakh 11,541. We got it in rupee terms. Now we should discount it. What rate do you think we can apply now? Since the cash flow we have converted into rupee terms, what discounting rate we can apply? Required rate of return for this project, 10% only directly we can use. So into 1 divided by 1.1. 51,92,310. Correct? 51,92,310. So what is going to be your NPV now here? 50 lakh is outflow. 51,92,310 is inflow. So what is the net amount? Same number, no? 1,92,310 you get rupees. 1,92,310. Same answer approximately, because around of we got some difference. So NPV can be obtained in two methods. Method 1, use the foreign cash flow and recalculate the discounting rate. Method 2, use the rupee cash flow and use the rupee discounting rate only. But to get the rupee cash flow, we need a forward rate. So use IRPT theorem. In both the formulas, IRPT theorem is being applied. In first method, in the adjusted rate discounting rate we calculate, IRPT has an impact. In the second method, to compute the forward rate, we apply IRPT. So you can choose either of these methods to present your answer in exam. I would recommend the second method, because every year the interest rate can change. If the project is given for 3 years, 4 years, every year interest rate can change. So every year calculating discounting rate might be difficult. So second method I would recommend, but you can choose either of the methods, you get the answer. Hope you are taken down. Let's go for full-fledged problem now. Any question on this one? Okay, let's go further then. Okay, so let's do this full-fledged question now, capital budgeting problem. Again, I repeat, there are two cash flows, two methods. Cash flow in foreign currency terms, use it, but discounting rate should be recalculated. At last, NPV you get multiplied by spot rate. Second method, you can use the cash flow in rupee terms every year. But how do you get the cash flow in rupee terms every year? You need forward rate. And how do you calculate forward rate? Using parity theorem. Let's apply this problem. Come to this one. Very frequently asked in exam again. XY Limited is engaged. Oh, I thought only people are engaged. Companies also engaged in large retail business in India. Today, I might extend the class by 5-10 minutes. I just want to finish this problem, nothing else. I just want to make sure this is covered. So please bear me with me for that. Only this problem, nothing else. It is contemplating for expansion into Africa of country by acquiring a group of stores having the same line of operation as that of India. Exchange rate for the currency of the proposed African currency is extremely volatile. Rate of inflation 40% a year. In India, it's currently 10% a year. Management of XY expects these rates are likely to continue in the foreseeable future. Okay. Estimated projected cash flows in real terms as well as African country for first 3 years of the project are given below. What do you understand by this real terms, duplicate terms? Real terms means before applying inflation. Before applying inflation. But they have given inflation, let's say for Indian inflation, Indian rate 10%. So how do you calculate this number? 1500 is before inflation. After inflation, how do you calculate? 1500 into 1 plus 0.1. That will be increased. 1 plus 0.1. 2000. Second year, can you tell me, how do you apply inflation for year 2? Second year inflation means you don't do 2000 into 1.1. You should do 2000 into 1.1 square, compounding 2 times. 2000 is today terms, today price. After year 1, increased by 10%. After year 2, increased by 10% once more. Similarly, 2500 into 1 plus 0.1 cube, because compounded 3 times, because 2500 is in today terms. After year 1, price would have increased by 10%. After year 2, price would have been increased again by 10%. After year 3, price would have been increased again by 10%. I mean, every year increased by 10%. Okay, now they have given cash flows in Indian, cash flows in African. And please understand, these are cumulative cash flows. Don't think, oh, 50,000 equals to 2 lakh, 1,500 equals to 50,000. Don't link like that. These are in Indian terms as well as African currency. In the sense, if you are starting a project in Africa, some cash flows will be there in India and some cash flows will be there in Africa. Once you start in Africa, their machinery should be purchased, employees should be hired, rent should be taken, and to do that, some project managers will be there in India who will take care of those overseas operations. So some permission to be taken from Indian government. So you have to apply. So cash flows in India will be there and cash flows in Africa will be there. They are and not equivalent, not this equal to this. So when you calculate NPV, you should calculate cash flows in Indian rupees and the cash flows in African put together if NPV is positive. Total you should take. These are not separate. These are cumulative. Both should be considered. These are not equivalent. And again, for 10% for Indian cash flows you take, 40% for African cash flows you take. And one more thing I forgot. This is real terms. Real terms means before inflation. What do we call after inflation? It's called as nominal terms. You might have heard of nominal GDP, real GDP. So before inflation is called as real, after inflation is called as nominal. So if they're using those terms, be careful. Real, before inflation, nominal, after inflation. Okay. XYZ Limited assumes year 3 nominal cash flow. The word came now itself. Year 3 nominal cash flow after inflation continued to be each year indefinitely. Sir, why are they telling indefinitely and all? Back to the corporate valuation chapter. How do we used to value a company? Year 1, year 2, year 3, year 4, year 5 onwards, where growth will be stabilized. Where we calculate, what do we calculate? What is that called as? When the cash flow stabilizes, we calculate some value. Then we discount it further. Perpetuity is a term cash flow forever. But after some year, the cash flow will stabilize. We compute one term. My question has the answer. Anyway, it is terminal value. For that purpose, they have given this. Terminal value. So what is going to be your format? Year 1, year 2, year 3, after that, which means year 4 onwards. Year 3 cash flow will run forever. So year 1, year 2, year 3 they have given. Year 4 onwards will be stabilized. It evaluates investment using nominal cash flows and nominal discounting rate. Okay, it evaluates nominal cash flow, nominal discounting rate. No problem. The present exchange rates are given. You're required to calculate the net present value of the proposed investment considering the following. African rands cash flows are converted into rupees, discounted at risk-adjusted rate. All cash flows for these projects are discounted at 20% to reflect high risk, ignore taxation, present value factor they have given. See, all African rand cash flows to be converted into rupees and discounted risk-adjusted rate. Discounted risk-adjusted, not exchange risk. Regular risk. So, which method do we apply? Do we continue with the first method where cash flows will be in a foreign currency and we discount it using the revised rate and then convert it to rupee terms? Do we use that method? Or every year cash flows are converted into rupee terms using forward rate? Which one do you think is recommended here? In the examination problem, if nothing is mentioned also, I would recommend the second method. Second method, in the sense, every year you convert cash flow. Sir, why are they giving them just a discounting rate? If every year you convert, you don't recalculate the discounting rate. Just to confuse you, they have given. This discount adjusted is not exchange risk adjusted. This is not exchange risk adjusted. This is not a exchange risk adjusted. This is other risk. You apply CAPM, RF plus RM as RF into beta, all the risk, financial risk, business risk, everything is involved. Or you apply arbitrage pricing theory, different factor premium you consider, all the risks, those risks they are talking. Purely exchange risk means this formula what we learned. But we are not applying here because cash flows are converted into rupees. Every year we apply second method using IRPT formula. Let's do it. Quite a few columns are required. Maybe 10-12 columns. Accordingly manage the space in the material. 10-12 columns. Year. 0 also I'll do. Initial investment also I'll write. Year 0, 1, 2, 3 and 4 onwards. Hope you remember. For terminal value, year 1, 2, 3 and after that year 3 nominal cash flow will apply forever. So year 1, 2, 3 given, 4 onwards. Many columns are required. Oh, let me tell you. Let me give you the idea of the columns. Then you'll be able to write it better. I just give idea of columns. What and all column? Year definitely we require. Cash flow they have given in African rands, but this is in real terms. What we should convert? Apply inflation. So this should be converted into nominal terms. Cash flow in African rands should be converted into African rands. Okay, let me do one thing. Let me just give you the process of calculation. You also take it down. Then we prepare the tabular thing. So African rands they have given. Cash flow in African rands they have given in real terms. This we should convert it to nominal terms. How do we convert? By applying inflation applicable to Africa. Cash flow in African rands in nominal terms. But this is African rands. We want to convert it to rupee terms. Cash flow in rupee terms. How do we convert? Into rupee terms, what do we apply? Forward rate. Forward rate means we need IRPT theorem. I mean, in this case, purchasing power parity, because inflation they said, interest is not given. So applying purchasing power parity theorem, compute the forward rate. Inflation rate they have given, interest rate not given. Okay, this is African cash flow. Apart from this, additionally you have Indian cash flow. Now, cash flow in rupee terms, they have given nominal cash, they have given real cash flow. They have given real cash flow. This should be converted into nominal cash flow first. Cash flow in rupee terms, nominal. How do we convert this from real to nominal? We need to apply inflation. Apply inflation. Apply Indian inflation. Okay. Okay. So here we have African rands converted to rupee terms and Indian rupee terms. So both are to be added. Total cash flow in rupee terms. And total cash flow in rupee terms should be brought down to present value, today value. How do we convert? We have to apply discounting factor, present value, interest factor. This present value, when you subtract investment, you get ultimately NPV. Hope you got the process structured in your mind. African rands real into African rands nominal, use their inflation. African rands nominal into Indian rupees using forward rate, applying purchasing power parity theorem. Indian cash flows real into Indian cash flows nominal, apply inflation. Cash flow of African rands converted in rupee terms, cash flow of rupee terms, both are in nominal value. You can do total cash flow you get, discounting factor you apply, that will give you present value. Adjust for investments, you get NPV. Hope you've taken down this process. African rands real into African rands nominal into Indian rupees. Indian rupee real into Indian nominal, total cash flow, present value, NPV you get. I'll take this part out. Okay. So here 0, 1, 2, 3 and 4 onwards, cash flow real in INR terms given. Write down whatever they have given. Then we convert it to nominal, applying inflation. Okay. Next, what is Indian inflation? Today, no inflation. Year one, you apply 10%. So 1,500 into 1.1. Show this calculation also. Later, you will not get it. 1,500 into 1.1. 2,000 into 1.1 square. 2-year inflation, 1.1 square. 2,500 into 1.1 cube. 3 years inflation to be applied. Then African cash flow real given. This is given. This is given. Nominal cash flow, how do we convert? Apply their inflation. Their inflation is 40%. Sorry. So multiplied by 1.4. Second, multiplied by 1.4 square. 40% inflation multiplied by 1.4 cube. Okay, what is the next column? What do you think will be the next column? We have cash flow in African rands. We need to convert into rupee terms. So what do we require? We require conversion rate, exchange rate using IRPT. What they have given? 1 rupee equals to 6 African rands. Here be careful while applying the IRPT formula, purchasing power parity formula. Don't do 1 plus local by 1 plus foreign. A rupee equals to African rands. This has become indirect code. Things can get confused. Left hand side, right hand side can be confused. But I told you simple method. How do you do? Simple method. We have 1 rupee equals 6 African rands. So while computing the forwarded, you know what do you do? Multiply this by rupee inflation, whatever that currency, left hand side currency, and this you multiplied by African rands inflation. So rupee inflation is 10%, so you multiplied by 1.1. African rand inflation is 40%, you multiplied by 1.4. Then 1.1 goes to right side, so you get 6 into 1.4 divided by 1.1. For African rands, multiplied by their respective currency, inter-inflation rate, divided by 1.1. You get 7.6364. That again you multiplied by 1.1, 1.4 by 1.1. Again you multiplied by 1.4 by 1.1. This is important. Hope you get it. Forward rate is put into 1 plus. If you are confused about that home currency, long currency, I told you 1 plus. Instead of local, you say RHS divided by 1 plus LHS. That is 6 into RHS currency, African rands, 40%. So 1 plus 0.4 divided by LHS currency, 1 plus 0.1. So either use RHS LHS method or use the simplest method. Whichever currency you have, corresponding inflation you multiply. On right hand side also, corresponding inflation you multiply. Very easy to apply. Did you get this one? Please confirm. Okay. I'll take this part out. Hope you got it then. Okay. Let's apply now. You get cash flow in rupee terms. This you should divide. Okay, remember this is African rand, right hand side. African rands, right hand side. So divide. 2 lakh divided by 6. 70,000 divided by 7.6364. 1,37,200 divided by this. So this column divided by exchange rate. 2 lakh by 6, 33,333. 70,000 divided by 6, 7.6364. 1,37,200 divided by 6, 9.9. 1,37,200 divided, sorry. 2 lakh divided by 6, 33,333. 70,000 divided by 7.6364. 9167. Hope you're getting numbers. 1,37,200 divided by 9.7190. 2,46,960 divided by 12.3696. Hope you get cash flows in rupee terms. So cash flows in rupee terms we have this column. Then cash flow in African rands converted into rupee terms. 2 cash flows. We have got it now. What we should do then? Total cash flow, net cash flow. These 2 columns should be added. Okay, let's add these 2 columns. 50,000, 33,000, both are minus, so total becomes 83. 1650 a minus, and 9167 is plus. So 7517. 2420 minus, but 14117 is plus. 11697. 3327 minus, and 965 plus. Okay, I'm rounding it up. This you will get as 8. 3328 you can do it. 3328. And this is year 3. Year 4 onwards, terminal cash flow 16,637 divided by K minus G. K minus G we don't have, no growth rate, so 0.2 only. Just 1 second. Okay, so 0.2 only, no growth rate, so just a perpetual cash flow, terminal value, year 4 onwards. Please confirm if the amounts are fine. Okay, what is the next step can you think of? Indian cash flow, real into nominal we have done. African rands, real to nominal, nominal to Indian rupees we have done. Total also we have done it. What's the next step? Bringing down to today terms, discounting factor. And we need not recalculate discounting factor because all the cash flows are converted to rupee terms. So discounting factor need not be recalculated. Directly you can use 20%. They have given the decimals points. And the last one should be same only. Hope you remember. Last two cash flows will have same discounting factor. Multiply, you get the total amount. And NPV is how much? So 83,333 into 1, 83,333 minus because investment, 7517 into 0.833, 6262, 11,697 into 0.694, 8118, 16,637 into 0.579, 9633, 83,185. Terminal cash flow will have same discounting factor as previous one. Last two cash flows, same discounting factor, 0.579. You get NPV of 11,156. In case you are slow in writing down, you can take a quick picture of this and copy it down later. I just want to discuss one important connection in this problem. With that, this problem will get over. Just 2 minutes, not more. Okay, hope you got it. And I'll write the conclusion. Since NPV is negative, project is not financially viable. Since NPV is negative, project is not financially viable. Project is not financially viable. Project is not financially viable or financially not viable. Financially not viable. Okay, one small point I would like to observe. If you are still writing it down, please take a picture of this. You can copy it down later. It's a manual process. I hope no confusion there. One small observation I would like to make a point, important one regarding the parity theorem. Should give you good idea. Look at this one. First mathematically, then logically. 50,000 became 70,000. How 50,000 became 70,000? We multiplied by 1.4. Correct? Then what we did? This exchange rate, we multiplied by 1.4, but exchange rate is divided. Effectively, what happened to 1.4 then? Since it's divided, 1.4 is divided, right? So 1.4 is multiplied, 1.4 is divided. Effectively, mathematically does not have any impact. Let's see whether it comes or not. So do one thing. So for this 50,000 African cash flow, don't use African inflation. Use Indian inflation only. Use Indian inflation. Please apply 50,000 into 1.1 divided by 6. 50,000, you apply Indian inflation 1.1. Then use spot rate. Then don't use the forward rate. Use the spot rate only. Divide by 6. You get the same answer. Here also. So in fact, this one circus we can reduce. For all these numbers also, we can apply Indian inflation and divide by spot rate. You get the faster answer. You can do this exam, provided you are very clear on the concepts. Okay. Mathematically, I told you, you verified. Logically, what does it mean? Indian person going into Africa and getting back the money to India. Even though Indian person going to Africa, the cash flows will increase by African inflation. When you come back to India, that inflation impact will be negated, will be nullified by applying the exchange rate. That is purchasing power parity theorem. See, what is the inflation? Indian person got very curious. Oh, if I go to Africa, 40% growth will have. India only 10% growth. 40% growth we want. Okay, go to Africa. 40% cash flow grown. 50 became 70, became 90. Cash flow grown like anything. But when you came back to India, whatever higher inflation, higher growth you had, well, coming into India, everything nullified. That is our basic assumption of purchasing power parity theorem. If it does not nullify, if you still have a profit, arbitrage. One country good for investment one country good for borrowing, those things will come. Anyway, right one, ultimate, what is the impact? You are Indian, you go to Africa, you go to Singapore, you go to Australia, whichever currency inflation may apply, but when you come back to India, the exchange rate will be there. No, that will take away all the inflation impact, all the interest impact. Ultimately, for the Indian, which is your growth? Indian inflation only matters. So don't have this too much fantasy about the foreign countries. Live in India. Anyway, just a suggestion. But you write down one line for your reference. For your reference, not for exam. Just one line. With that, we'll complete this problem. Indian investor. Indian investor investing in Africa. Indian investor investing in Africa. Indian investor investing in Africa may have cash flows, may have cash flows, may have cash flows, may have cash flows by applying African inflation. May have cash flows by applying African inflation. By applying African inflation. By applying African inflation. May apply African inflation. By applying African inflation. However, when it is converted back to rupees, however, when it is converted back to rupees, when it is converted back to rupees, converted back to rupees, such inflation effect is nullified. Such inflation effect is nullified. Such inflation effect is nullified, and overall, Indian inflation applies. Overall, Indian inflation applies for Indian investor. Overall, Indian inflation applies for Indian investor. Indian investor. Okay, just write the amounts also. 50,000 into 1 plus 0.1 Indian inflation divided by 6 also gives you 9167. Just show you that number somewhere, that connection. 50,000 into 1 plus 0.1, that is Indian inflation. Indian inflation divided by spot rate, of course. So apply only Indian inflation, 11 for Indian investor. Okay, that's all point I wanted to confirm. So what we are doing, international financial management, is all about either an Indian company going outside India or a foreign company coming into India. We had looked at those kind of problems. We also have working capital management. In the sense, the MNCs, multinational companies, will have branches in various countries. How do you manage your funds? Where you keep your funds? That kind of problem we will do one or two. Come to this problem. Your bank's London office has a surplus funds to the extent of US dollar 5 lakh for a period of 3 months. Your bank's London office. So basically your bank is in London. You're talking about a UK person point of view. But they have dollars of 5 lakh. Mismatch. First sentence itself, there's a mismatch. You're talking about a bank in London where they're supposed to have pounds, but they're having US dollar. Can, right? Banks are, after all, they can deal in foreign currencies. So though it is from a London bank point of view, London bank can have multiple currencies. One of the currency they have surplus US dollars for a period of 3 months. The cost of the funds to the bank is 4% per annum. It proposes to invest these funds in London, New York, or Frankfurt, not all the three, one of the three places, and obtain best yield. They want the best one, the best returns, without any exchange risk to the bank. That is, complete hedging should be done. The following rates of interest are available at the three centers for investment of domestic funds there for a period of 3 months. If you invest in London, 5% per annum, New York, 8% per annum, Frankfurt, 3% per annum. The market rates in London for US dollar and euro are given. US dollar slash euro. So how do you understand this? London on New York. London on New York. Meaning, do we say this is £1 equals to $1 equals to? London on New York. Or this, whenever you think about these pounds, remember, pounds are always this problematic. These English people are like that, I think. Wherever you have the problem that this pounds comes, you have to be double careful. They win the World Cup, there is a problem. They do, they have some, whatever they have a problem. So whenever they say market rates in London, usually if I say market rates in India, we don't trade in rupees, right? We always trade in dollars, we trade in pounds, we trade in euro, in terms of rupees. We say base per currency or price currency like that. But we don't trade in rupee itself. But these people, London, when they say London market, they don't trade $1 equal to, they trade £1 equal to. That's how they have become. Anyway, that's the practical stuff. You keep that aside. London and New York, it is £1 equals 1 GBP equals so much of, they said New York, meaning dollars. Spot 1 month, 2 month, 3 month. That means they've given the swap points. And swap points, they have given in terms of 2 decimals. Don't take 2 decimals. But 4 decimals are there originally. So from right to left. So these things should be taken swap points in the last 2 digits when you are finding the forward rates. London on Frankfurt, £1 equal to so many euros. At which center will be investment made and what will be net gain to the nearest pound to the bank on the invested funds. Okay, also look at the forward rates here for this Frankfurt. We are having 3 points and all, 2.3 points. They give 2, 3, does not matter. We should always take it from right to left. Last 2 digits, and if they given 3, last 3 digits. Clear? Okay. Now basically here we have to decide, should we invest in London, should we invest in New York, or should we invest in Frankfurt? 3 choices are there. So investment, in what are the things? You have investment in London or investment in New York or investment in Frankfurt. We have 3 choices. How much amount you are going to invest? They have given 5 lakh US dollars. Very clear. Cost of the funds to the bank is 4%. You have a surplus funds. Why they are telling cost of the funds? When you have, I told you, every source will have a cost. Either own source or borrowed source. Own source, you call it as opportunity cost. Borrowed source will be called as interest. But either of the cases, there will be a cost. Now, for decision making purposes, cost of the funds in all the 3 cases is similar only, but still, it is going to make one difference. I'll tell you why, and I'll also tell you later when it's not going to make a difference. Okay, for the time being, let's consider this. When we can ignore, I will tell you later. Cost of the funds to the bank is 4%. It's as good as opportunity cost. or as good as, let's say there is a borrowing in US dollar. Let's treat like that. Your investment can be in London in pound terms. Your investment can be in New York in dollar terms, or in Frankfurt in euro terms. But your borrowing, what you have, will be in dollar terms. That's because it's an opportunity cost, or you have borrowed. You have $5 lakh. It's an opportunity cost of the funds. But for treatment, calculation purpose, for easy understanding, let's treat them like a borrowing. So you have borrowed 5 lakh, you're investing 5 lakh. Let's treat like that. The investment in London means you'll invest in pounds, that is GBP terms. New York means in USD terms. In Frankfurt means euro terms. Okay, this is investment. But borrowings, the source, borrowings everywhere is in USD terms only. Because they're not asking where to borrow. That they're not giving. They have 5 lakh. We treat them like a borrowing. We have borrowed 5 lakh. We have to repay later. We'll treat like that. Okay. Investment in 3 currencies, but borrowings in US dollars. Okay. In all the 3 cases, we have borrowed $5 lakh. USD 5 lakh, USD 5 lakh, USD 5 lakh. Now this USD 5 lakh need to be invested. How are you going to invest is the requirement of the problem. Focus, quite a few things are there. Okay, presently you have USD. You have to deposit in pounds. So USD should be converted into pounds, into GBP. Okay, now tell me, USD will be converted into GBP in spot rate or in forward rate? Which amount will come to it later, but which rate do we apply? Because you are having US dollar, you have to convert it into pounds, you need a conversion rate. Will you convert it at spot rate or will you convert it at forward rate? Depends on when are you converting. In case of London, you should deposit today itself, right? If you want to get the return in London terms, you have dollars today. Deposit made should be done today. Therefore, what rate we require? US dollar to GBP will be done using spot rates. You are depositing today. So you need spot rates. Now from GBP, you are going to deposit, and this will give you return of 5% pounds. 5%. So here your answer will be in GBP terms. Ultimately, this will be in GBP terms only. And what answer we want? Ultimate answer should be in dollars or ultimate answer should be in pounds. Look at the question. What will be the net gain? In nearest pounds. Our answer should be in pounds. Investment we got it in pounds. That is over. Borrowings we have got in US dollars, but we need it in expression pounds. Okay. Now US dollar 5 lakh is today. It has having a cost of funds of 4%. It is like I told you, you have borrowed 5 lakh. So you have borrowed 5 lakh US dollar. It will become interest at the rate of US dollar. You will have interest at the rate of 4%. It will become US dollar only along with this one. But our answer cannot be expressed in USD. We need to convert in GBP terms, or other way around. This borrowing need to be repaid. We borrowed earlier. We need to repay it. So USD to be repaid in, we need to repay in USD terms. So we have to convert it into GBP. Why should we convert into GBP? Please keep the overall structure in mind. Think about liability side. We have borrowed 5 lakh. After 3 months, we have to repay 5 lakh dollars. Where do you get the money to buy the dollars? We have to buy using GBP. Using the GBP. Where we have GBP? The deposit what we have. Correct? The deposit will give you GBP maturity. Using the GBP, you are going to repay your borrowings in US dollar terms. You need to repay the dollars. Ultimate answer surplus will be your profit. Okay. Now, this is going to be spot rate or forward rate. 5 lakh US dollar today. On that 4% for 3 months you apply. And then after 3 months, you need that US dollar to be purchased to be able to repay your borrowings. After 3 months, you need to purchase US dollar. So you are going to use a forward rate. I'll just say FR, forward rate. Now, once you express in GBP terms, investment also in GBP terms, difference will give you overall profit or loss. Overall profit in GBP terms. Overall profit in GBP terms. Okay. Is this first option clear? Amounts and all will calculate later. But first, are you clear about the process? You see the arrow I'm writing. I'm converting it today. So I'm writing spot rate. On that interest, to one line arrow. And then it comes to which currency. And here I'm applying forward rate after the 3 months. So the arrow coming later. So be careful about the presentation I'm doing here. Clear up to this point? Any questions? Any doubts? Please be specific in your doubts. No doubts? Shall we go further then? Okay. Now, let us go to the second choice. Going to New York. If you want to invest in New York, you need USD. You have USD only. So do you need a conversion rate today? What do you think? You have USD with you. The deposit in New York means will be in USD terms. Is there a need for conversion today? Definitely no need. So the USD what you have itself will give you, no need to convert. The USD what you have itself will give you the rate of interest at the rate of 8%, and it becomes US dollar after 3 months. Now this USD should be converted into GBP after 3 months, once the deposit matures. So which rate is relevant? After 3 months. Therefore the relevant rate is forward. I'll just say FR. Hope you understand. This conversion taking place after 3 months, once the US dollar deposit matures. So forward rate. I'll write this slightly differently, but okay, that's fine. No problem. It's also fine. So now here what we are going to do, US dollar, same thing only. That borrowing does not change. US dollar, you are having borrowing, you will pay 4%. You have to repay US dollar after 3 months, and you need to purchase so much of US dollar using GBP. Therefore, you need a same forward rate. So this borrowing, whatever in the previous situation, will be there in the current situation also. Fine. Are you clear about the second alternative? Very simple one. You have US dollar, convert into the US dollars because deposit only is there, so no need to convert actually. Deposit directly, you get the maturity amount after 3 months, then convert it to GBP terms. The borrowing what we discussed in the previous thing applicable here also. I hope it's fine. Okay, now Frankfurt. Now Frankfurt, you have USD with you. If you want to invest Frankfurt means you have to convert it to euro terms. In which rate? What do you think? Spot rate or forward rate? You need to convert it to today to be able to do deposits. Therefore, you need to do what? Spot rate. Spot rate. But interesting point. Do you have USD Euro? You don't have USD Euro. You only have London Euro. London on Frankfurt. London Euro. USD Euro is not available. London USD available. London Euro available. USD Euro not available. So we have to make use of cross rates. So while doing this, we have to apply cross rates. So in between you can just write USD to GBP and GBP to Euro. Cross rates, basically we will apply cross rate. USD to GBP, GBP to Euro. Cross rates is applicable. Okay. On Euro, how much interest will you get? On Frankfurt, you get 3% per annum. You get 3% per annum. Okay. So you get Euro after 3 months. After 3 months, you get Euro, but we can't express the answer in Euro terms. We have to convert it into GBP. Ultimate answer should be in pounds. So here we use forward rates. After 3 months, we are converting. Does it require cross rates? Not required because Euro to GBP available. So on the spot rate, we had to take cross rate because we are starting from US dollar. Now, after 3 months, we have Euro to be converted into GBP. Answer should be in GBP. Euro to GBP rates are available. So cross rates not required. You can simply use the applicable forward rates. Clear? Now this borrowing will be same only. US dollar will 4% interest. We have to repay in US dollar terms, and for that need to be purchased from the market. So you will convert it to GBP using forward rate. And overall profit in GBP terms in all the 3 cases, whichever is higher, we are going to select it. Okay. Now one thing if you observe here, this borrowing is same in all the 3 cases, right? In the first case also 5 lakh, 4% interest. Second case also 5 lakh, 4% interest. In third case also 5 lakh, 4% interest. Common in all the 3 scenarios. So does it make difference? In all the 3, your cost of borrowing will be same. Outflow will be same. Investment will be inflow, borrowing is outflow. If outflows are same in all the 3 cases, does it going to make any difference in your decision making, relevant costing? When something is common to all the 3, it's not going to make difference. But in this problem, it's going to make difference. I'll tell you why. But in some other problems, we are not worrying about where to borrow, invest like this, because the cost of borrowing would be same in general. Where to invest, wherever we get the higher interest, we are going to invest it. That's it, very simple. But here, even though borrowings are common to all the 3, It is going to make a difference. You know where it is going to make a difference? It is going to make a difference in the second alternative. Second alternative. Because you look at this one, US dollar deposit and US dollar borrowing. Now, since both are in US dollar terms, why do you like to purchase the USD as well as sell the USD? Why do you want to do that? Are you understanding? We will set it off. That's called as netting. That concept is called as netting. We have US dollar deposit maturing in dollar terms. We have dollar borrowing maturing in dollar terms. Now, instead of converting them separately, why don't you net it off? You can save the conversion rate. Why, sir? Because when you buy the dollars, you buy at a higher rate. When you sell the dollars, you sell at a lower rate. You lose the differential, the spread. We can save the spread if I can set it off. So US dollar deposit will happen. US dollar maturity will happen. Net it off. Net amount only. You convert it to dollars. In the sense, I convert to pounds. You are having US dollars. It provides 8% interest. It becomes USD. Borrowing also you have US dollar, which provides 4% into USD. Don't convert them separately. Net it off. Net amount, whatever net USD you get, that net USD you convert it to GBP using one forward rate. Net USD. Net USD, convert it into GBP using one forward rate. The spread can be saved. See, for example, you have to receive from one person $1 lakh and you have to pay to another person $1 lakh $2,000. Instead of buying and selling, you pay him directly. So that spread can be saved. Purchasing and sale, the cost can be saved. That is the intention of set off, netting. Because of this netting mechanism, all the three situations, your cost of borrowing is not going to be same, or overall profit will not have a same impact. It will have a different impact. If this was not there, if the netting was not there, then all the three situations, the cost of borrowing would be same. It's as good as you can even ignore it for the purpose of decision making. But here you can't do it. Sir, can I set off? Can I do without netting? Will marks be given? No. You have to provide the best yield possible. The best yield possible means you have to apply your best skills everywhere. You have an opportunity to reduce the cost. You should do it. You can't write a note telling netting is not done. No, you don't have a choice. You have to do it. You have an opportunity to reduce the cost, to save the spread by netting. You should do it. This is the overall structure. Now we'll have to calculate one by one using the numbers. Let me know if you have any doubts. Else we'll go for calculation. You can see how important this problem also came in the exam also many times. RTP also it's there. Against every problem, I've given the source. So you understand how many times the question has been repeated. Okay. Hope you got it. Let's do one by one. First, let me do investment in London. Okay. So you have US dollar 5 lakh, convert it into pounds in spot rate. Okay, what is the exchange rate we have. Uh, Spot rate 535090. 1 pounds 1 GBP equals 1.5350 hyphen 1.5390. Don't take just a 90. It's 5350 5390. That's how you should read. Last two digits. 5350 5390. And what currency you are having? US dollar, left hand side. No, US dollar, right hand side. Oh. This is 1 GBP, so much of USD. We are having right hand side. Right hand side means we should divide. Right hand side, we should divide. Then with respect to dollars, what we are doing? We are converting it to pounds. So pounds we are buying. We don't think from pounds point of view. We think from currency we have, which is US dollar. So US dollar, we are converting. That means we are selling. So selling USD at a lower rate. Selling will happen at a lower rate. But because we are dividing, it will be 1 by higher rate. Therefore, 1 by 1.5390. So, how much the GBP to be deposited? GBP to be deposited 5 lakh USD into 1 by 1.5390. Now you get 324886, right? 324886. Okay, so this is in pounds. Okay, this is investment. Borrowings now. US dollar 5 lakh. Borrowed today. Borrowed today. Repayment after 3 months. Sorry, before that, this deposit will give you maturity. No, let me do that first. I'm sorry. Let me just give you the interest. This GB to be deposited on that interest for 3 months. 324886 into rate of interest, we calculated 5%. We applied 5% for 3 months into 3 by 12. $4062, is it? Okay, 4061. 4061. So, what is the deposit maturity after 3 months? $328,947. All in GBP terms. Okay, so this is the deposit portion. Let's come to borrowing portion. Okay, borrowed today. 5 lakh USD. Plus interest for 3 months. 5 lakh into, I think, 4% for 3 months. I think 500 or 5,000. 5,000. Okay, 5,000. So 5 lakh 5,000. So repayable after 3 months. 5 lakh 5,000. This is in dollar terms. Now, if you want to repay the borrowing, you need to have the dollars. So you purchase from the market. From the market, I purchase and I will give it to my repayment. But I did not have and wanted to have any uncertainty. They said perfect hedging. So the purchase rate, I did not want to go to spot market. I said I'll go to the forward market. That's why I'm using forward rate. So USD converted to GBP at forward rate. USD converted into GBP at forward rate. Okay, now am I buying or am I selling? GBP need to be purchased, USD need to be purchased. Correct? USD need to be purchased, and I need US dollar only, which is the currency mentioned. Therefore, we need USD purchase rate. USD purchase rate. Okay, so what is the rate available after 3 months? So 5350 was there. We need USD to pounds. Okay, this one only. 5350 plus 80, 5350 plus 85. Let me add it here. Okay, the spot rate was, I'll just write here. I have a space, you can write below. I have some space here, I'm writing it here. You can write below that. Spot was 1.5350, 1.5390. Don't we need GBP? GBP you need, but you have GBP already, right? The deposit maturity, you have GBP. What you need to repay is in US dollar terms. How many GBP required to repay your US dollars? The deposit you have is giving you GBP. GBP it's in your hand, but entire amount is going to be used for repayment? No, right? How much US dollar you need? I need 5 lakh 5,000 to repay my borrowing. Okay, you buy 5 lakh $5,000 in the market. How much GBP required to buy the USD? So that my USD repayment can be done. I don't need to buy GBP. I have GBP in my deposit already. Are you clear on this? Using the GBP deposit, how much GBP required to be able to repay my US dollars? We are not converting borrowing to GBP but deposit to USD. No, I don't know. I did not understand your question. You keep the deposit borrowing side. Don't mix it. Borrowing, you keep it separate. Deposit, you keep it separate. Don't mix it. Let's talk about borrowing. Today you borrowed 5 lakh dollars. And after 3 months, the $3 has to be repaid. And to repay the dollar, you have used it for some purpose. Let's say some purpose you used it. Now you need dollar to be repaid. You need dollar to be repaid means I have to purchase like an importer. I have a liability in dollar terms to be able to make the payment to my supplier. So what will I do? That foreign currency is purchased in the market. Same situation. I have to repay my US dollars. I need US dollar, which I purchase in the markets. I hope you got the clarity. Okay. Okay. Spot 1.5350, 5390. Okay. Now, the 3 months swap points given 80, 85, increasing, and last two digits. Actually, first one, 2 month not required. They're given just to confuse you. Okay, 80, 85. So 0.0080, 0.0085. Last two digits only you add. 80, 85. Increasing order. So you add 80, 85. So what do you get? 1.5430 and 1.5475, right? 5430, 5475. Okay. Now, here we are purchasing USD. In USD right hand side, so we divide and we have to purchase. Purchase means purchase at a higher rate, and because we are dividing, it is higher rate is 1 divided by lower rate. So 5 lakh 5000 USD multiplied by 1/1.5430. 327284. You can say 285. Yeah, does not matter. 327285. So overall profit, overall gain, you can say arbitrage gain also because it's coming back to pounds. 328947 minus 327285, 1662 pounds. Like this, in other two situations also, you compare and see which one is beneficial. Shall we go further? Okay, next. Investment in New York. Investment in New York is not complicated. You are having USD 5 lakh. So deposits and borrowing, both. Deposit and borrowing. Deposit 5 lakh USD today. So you get 5 lakh US dollar. Add interest for 3 months. Five lakh multiplied by how much we get on US dollars terms? We get 8%. 8% for 3 months. 10,000 USD. So after 3 months, it becomes 5,10,000. Similarly, borrowing, we have borrowed 5 lakh today. Plus interest for 3 months. Which we already calculated actually. So on 5 lakh USD, we are having 5,000 interest, right? We already calculated. So you get 5 lakh 5,000 USD. Remember, I'm not converting this US dollar to GP separately. Net USD, which needs to be converted. So 5 lakh 10,000 minus 5 lakh 5,000 net USD 5 lakh. You get 5,000. 5,000 USD. Okay. Now USD to be converted into GBP using the forward rate. Are we going to sell or are we going to buy? USD to GBP using the forward rates. Since we have to convert USD to GBP, we have to sell it. So again, USD rate, what is the quotation? We have the same rate available after 3 months, 1.5430, 5475. 1.5430, 5475. This again USD, right hand side. So you divide, and then you have to purchase USD. No, you have to sell USD. And selling USD means at a lower rate, and lower rate is 1 by higher rate. So 1 by higher rate means 5475. So 5,000 US dollars into 1 by 1.5475. 3231 bonds. 3231 GBP. So overall gain same only. 3231 GBP. Borrowing rate is less than deposit rate. Can't we borrow unlimited funds and earn the difference? See, even in a business, when you make a business, your rate of return on investment should always be more and your borrowing rate should be less. So, can you borrow unlimited funds? The fact is no, it should be there unlimited funds. No. See, when you say borrowing, it will not be same rate for your entire money. You borrow 1 lakh, one rate might be there. Borrow 2 lakh, one more rate might be there. Borrow different amount, different rate might be there. Therefore, you cannot borrow how much ever you want. You can borrow only what is the amount available. And in general also business way I can talk like this. No, my cost of capital is less, my return on investment is more. So I can borrow unlimited money and I can invest and generate money. But like that, the bank should accept so much of deposits. And you should have the borrowing for how much ever you borrow. That borrowing will not be available. The rate of interest will not be same. Even for borrowing, even for deposits. So unlimited funds question do not arise. Okay, so overall gain 3231 GBP under second alternative. Okay, third alternative. Okay, investment in. Is there a question of exchange risk adjusted rate of return interest here? Not there, because the required rate of return is cost of borrowing is taken in currency term itself. In US dollar itself, we are taking the rate of interest. We are not converting that borrowing into GBP terms and all. So borrowing cost of capital means required rate of return. That's what you're talking about, exchange rate adjusted. In this question, that do not arise. Because the US dollar borrowing, we are applying their rate of interest itself and applying the forward rate in the using the forward rates. You understand? What we used to do, we had two choices. Cash flow, convert into rupee terms using IRPT theorem, or discount it using your exchange risk adjusted discounting rate. In this problem, IRPT theorem was not required because the forward rates are available in the form of swap points. So we don't require IRPT, we use that concept. And moreover, the concept of exchange risk adjusted discounting rate, the cost of capital, all those things we use for capital budgeting, long-term decisions. These are short-term decisions. So we don't compute the present value. You can see in this problem also, everywhere I've computed the gain after 3 months. So even in the supplier rate versus bank rate, we calculate the actual cash flow after 3 months, 6 months, whatever it is. We don't do present value method. For short term, usually working capital management, we don't really go for discounting thing. So exchange risk adjusted thing is not required. But is there an impact? Yes, definitely there is an impact indirectly. Because when you consider the forward rate, they will be influenced by the interest rates in respective countries. So that way impact is there, but we don't have to worry about it. Okay, let's go to the last one. Investment in Frankfurt. Okay, so regarding the investments, then I'll come to borrowings. Borrowings, I'm keeping very, very less space because anyway in first part of the problem, we already done it. US dollar to GBP, how much we know. So borrowing is not a problem. Investment is what you need to be careful about. So you're having USD to be converted into GBP, and this one to be converted into Euro. Okay, so I told you, it depends on your objective. Keep everything in purchase terms or keep everything in sales terms. In this problem, you are having US dollar 5 lakh with you. You want to sell the US dollar. Since you are selling US dollar, is it going to be sell everywhere, buy everywhere? I only told the answer. You are getting rid of US dollar. You have to dispose of US dollars. You have to convert US dollars. So everywhere it's going to be in sale terms. So which one you sell first? Here you sell USD. And here you sell GBP. I told you, I know in every transaction there will be a sale, there will be a purchase. So don't tell me, sir, selling GSD means buying GBP, selling GBP means buying Euro. That means you're not understanding what I'm telling. I mean, if you think like that, always express everything in sale terms or always express everything in buy terms to avoid confusion. If you're confident, you can think in both the angles, you get the answer. But till that, you do it in a stepwise manner. Okay. Now USD to GBP. What is the rate available? Let's write down once. USD to GBP. Spot rate. Same, I think 5350, 5390, right? 5350, 5390. 1 GBP equals 1.5350, 1.5390. Everything spot rate. USD. And one more, GBP to Euro, 1 GBP equals 826090. 1.8260 hyphen 1.8290. Okay, now please Focus. You are selling USD. USD which side? Right hand side. Therefore, you will divide. And selling at a which rate? Selling at a lower rate. And lower rate means what? 1 divided by higher rate. So 1 divided by 1.5390. 1 divided by 1.5390. Next, selling GBP. GBP is which side? 1 GBP equals to so many euros. 1 GBP equal to so many euros. Since GBP is left, GBP is what we have to sell, and GBP is on the left hand side. Left hand side. Therefore, we will multiply, and we are selling at a lower rate. And lower rate, because we are multiplying, straightforward lower rate 1.8260. So how much euro to be deposited today? Uh, 5 lakh USD multiplied by 1 by 1.5390 into 1.8260. Or you can convert to 4 decimals also. That way also you can do. Okay, let me do that. You can convert to 4 decimals. Instead of taking it directly, let me express in 4 decimals. You can do directly also. So you get 5 lakh USD multiplied by 1.8260 by 1.5390, 1.1865. You can do directly, or you can do like this also. Both ways it's fine. 593,250. This is in euro. You can do 593,242, or you can do 59250. That's rounding off, it's fine. That depends on how much decimals we take. Okay. Plus interest for 3 months. In euro terms, euro interest was 3%. $593,250 for that 3% for 3 months. 4449. 4449. This also euro only. So deposit maturity. $597,699. Okay. Now this to be converted into pounds after 3 months. So in pounds terms, in GBP terms, euro to be converted into GBP. Again, I have some space here, so I'll use it, or I'll just use it here. The forward rate we require after 3 months. So I'll make use of the quotation given, euro and GBP. Spot 826090, 1 GBP, 1.8260 hyphen 1.8290. Then 3 month swap points. Swap points, please observe 145, 140, decreasing, descending order. So to compute the forward rate, since the swap points are descending order, we should not add, we should subtract. 145 slash 140, descending order, and last 3 digits 145, 140. So subtract minus 145, 140. So how much you get? 1 GBP, 1.8115, and 1.8150. 8115, 8150. Hope the numbers are fine. Okay, now we are converting euro into GBP. We have euro with us. Euro is right hand side, and right hand side means we will divide, and we have to sell because convert into pounds. So selling euro at a lower rate, and because we are dividing, it is going to be 1 divided by higher rate, which is 1 by 1.8150. 329310. 329311. Okay, 329311. This is in GBP terms. Borrowing to be repaid, that we already discussed. Borrowing repayments. After 3 months in GBP terms from first situation, from first investment, from first calculation. From first situation, we already calculated. 327285. 327285 GBP. So overall 327285, 329311, 2026 GBP. $2026 GBP. So in the last situation we got 2026. In the previous situation 3231 and 1662. The highest is in 3231. So you can write down one line recommendation. Investment in New York is beneficial. Investment in New York is beneficial. Investment in New York is beneficial. Okay, hope it is fine. Let me know if you have any doubts. And right, the overall conclusion also, investing in New York is beneficial. Again, this problem has come in the exam very few times, but this problem should give you lot of revisions, lot of concepts, because in this problem you have conversion rates, you have cross rates, you have application of swap points, you have borrowings to be repaid, and netting concept is there, cross rates is there, uh, right hand side divide. So many calculations are there. It seems complicated one, but this will give you good practice in the concept, especially your conversions. So you can do this problem multiple times to get the confidence. Okay, hope you got this one. Shall we go further?